investing, right? As we know it. So welcome everybody, and I'm glad to have you all here. So before we start, can anybody tell me like what your goals are? Why do you want to start investing? What are you looking to achieve? Have you invested before? Because one thing that's common amongst everybody, people say things like, "Oh, I've tried investing, I lost money, and then I tell you not to do it," or "I am too scared to actually start investing." Does anybody want to share why they want to start investing, what their goals are, and yeah.
Yeah, I want to start investing because I really like the idea of compound interest. And I already started a couple of months ago, but I am usually confused on what to buy, what will do well, and sometimes I find myself asking ChatGPT. So that's why I decided to join a class to know exactly what.
Sorry, who is talking? Hi. Sorry, I didn't get your name.
Oh, my name is Jennifer.
Okay. This is Jennifer. Did I hear
Yeah.
some? Yeah, hi, namesake. Oh, that's interesting. Well, you're on the right track. Any other person wants to share why they want to start investing? Guys, don't forget, this is an interactive class and workshop, right? And it's gonna really help us if you say what you're looking to achieve, if you ask questions, because guess what? It'll also help me to, teach you guys things that I might have forgotten or left out. But I can only do that if you actually ask me questions and if you actually if you participate, right? So if you to get the best out of this class, can we please keep it as interactive as possible so that I won't be talking to myself? So another person wants to share.
All right, my name is Benga.
Hi, Benga.
Hi. So basically, I'm joining the class because I want to know more about investment. I do some investment here and there, but I'm basically seeking knowledge on what I do need to know before I go into, investing in something like some stocks or, the exact information that is required to, before I put my money into it.
Yeah.
Because I see myself, investing, but without the knowledge.
Okay. Thank you, Benga, for sharing that. Anyone else wants to try before we proceed?
Hello, my name is Joan, and it's nice
Okay.
to meet every one of you.
Nice to
The
meet you
reason
too.
why I joined this class is because I would like to know more about investing, stock markets, and stuff like that. So yeah, and I look forward to learning more.
Okay. Thank you, everybody that has introduced themselves. So, like I said, my name is Jennifer, and a little background story about me. I have experience investing across various asset classes, stocks, crypto, mutual funds, money market funds, euro bonds, corporate bonds, commercial papers, treasury bills. I have invested across all asset classes. Although my current favorite is the stock market. Yeah, so I started investing over, let's say, 15, 16 years ago. I started quite early. Yeah, and when I started with 50,000 naira. And well, fast forward to today, like I have investments in multiple six figures in pounds. So yeah, so I think that's like the first lesson is that you can start small. So quick housekeeping. Investing is not a get rich quick scheme, right? So if you want to get rich quick, this is not a class for you. Although I always say that you can literally get rich and make so much money as an investor in the stock market. However, see that as a benefit of being an investor, not as a reason to invest. Otherwise, you're going to make mistakes and you're going to lose your money. Um, I did this slide, like, I don't know, I'm supposed to take that note out. I am a trader actually, but the time I did this particular slide, I was not a trader. I am a trader now, but I'm still a wealth builder. So when it comes to stocks, you can make money two ways, trading and investing. It's funny because whenever I invest in a stock, I trade that stock as well. So yes, you can trade. However, I always say things like only do what you know how to do best. As a beginner, building wealth, investing, that is like the most feasible and the most advisable and the easiest way to build wealth. So have a notebook and pen, right? I can guide in this class stocks to buy because we're going to invest together. That's stocks that I know that I'm literally going to like swear and give you. I mean, to be fair, I'm not like saying I'm perfect, but I think like all my stocks from last year to this year has been a hit back to back. So stocks that can literally 3x your money at least, or at least give you 100% return in the next couple of months. Could be months again, it could be 1 year, but the market has literally shocked everybody. Stocks have been doubling and tripling in months. So other than that, I will not invest on your behalf. I will not trade on your behalf. I will not send you a message afterwards saying, oh, bring your money, let me do. No, I wouldn't do that, right? Then other than that, forget about the invite people to this class right now. Okay. So I'm guessing that all of us here, we have a job, a 9 to 5 job, or we could be entrepreneurs. Or if you're like me, I really want to retire early, right? Or I am ready to quit my job because I don't want to wake up early in the morning every day and have to go to work. Or you're a parent looking to build wealth for your children. Or you already start making extra income and not just extra income, but passive income. But generally, you're ready for change in 2025. So you're looking to invest, create income, grow your finances, become better with your money, and build wealth. So this is our persona, right? I'm guessing that at least this persona matches at least 1 or 2 people here. I am in the retire early, ready to quit my job. Unfortunately, I do not currently have a 9 to 5 job. Investing is my job. That's what I've been doing for a long time. So this is just our personnel. So what this means is whichever category you fall under, it is very possible and feasible for you to start investing and start building wealth. Okay. So now imagine if you're able to create passive income, like from this year, you start laying the blocks like for you to start earning passively, brick by brick, like little by little from all the strategies you learn. So I tell people like investing is like opening a business, like or investing in a business. The only difference is you're not going through the hassle of starting the business yourself, looking for customers, looking for like a shop or a place like, rent or what to do. You're instead giving your money to like already established companies like the billionaires. When you invest in a stock like Meta, you're giving Mark Zuckerberg your money, to help you make more money, right? So that is basically what investing does, which is why it's one of the easiest and simplest and smartest way for you to build wealth. And guess what? It's accessible to everybody and anybody, right? You don't have to have a certain amount of money. You don't have to be working in a certain profession for you to like earn that or for you to start investing. Okay, so what I realized, I've been investing for 15 plus years now. Savings will not help you grow your money. I know so many of us are slightly risk averse, but we'll talk about risk versus reward later down, like as we progress in the class. So many of us are risk averse and they say things like, oh, I just want to save my money. I want to keep my money where I can see it or where I can access it, which to be fair is fine, right? Because again, when it comes to money, you have to do what you're comfortable with. However, when you think about things like inflation and the way the world is going right now, like we've seen what AI is doing, people are losing their jobs. You see that it is very important now more than ever for you to start investing. So investments can help you start your journey to financial success, ease and peace. Wall Street is for everybody, right? The New York Stock Exchange is for everybody. NASDAQ is for everybody. London Stock Exchange is for everybody. So someone that has 1 million can be a Wall Street client, and you and me that have £100, we can also be Wall Street clients, right? So spending money, looking good, that has nothing to do with creating passive income. So I say this because when I say spending money and looking good is because whilst you're doing that, unless you have a lot of money to deploy, that's unless you earn a lot of money, like you're a high income earner, then you want to prioritize investing your money. Sorry, 1 minute. Someone is here. I need to admit someone. 1 minute. Admit to the admit as well. Okay. How many people? Sorry, I just need to admit everybody. Admit. Okay. Okay, so that's that. Okay, so next slide. Okay, I've talked about this one. Now let's start with why we invest our money. So we invest our money to, build wealth, for your money to grow, to beat inflation. You want to make sure that your investment is keeping up with inflation. It's either above or at par with inflation. But as investors, our goal is to beat inflation, not to invest and get interest rates at par with inflation. So you want financial independence, you want financial security, you want financial freedom. So again, like I say, for me, retiring early is the goal number one. Not having to work for money, like how like if you don't work, you will not make money. That is the next goal. So basically freedom, the freedom to make choices, the options that come with having that money. And aside that, when you learn how to invest and you're intentional about your investing, it is like a skill that nobody can take away from you. Like, so when I say nobody, like you become confident, right? So you can quit your job and know that, okay, I have something to fall back to. You can choose to move to a different country or, take more risk because, you have something to fall back to. Not only do you have that to fall back to, you also have the skills as well to not only grow your money, but to multiply your money, right? So this is a reason why we invest. Like I said earlier, some of us want to invest maybe to give our children better lives. Other people are investing because they want to travel the world. I mean, I've seen someone that said, you know what, I just want to make enough money and travel the world. I couldn't be bothered about buying a house or buying a car. And yeah, that is their why. So you need to know your why. Your why is like the foundation, the base of investing. So on top of your why, it's like like I said, the foundation, that's where you now put your building blocks. And it's important because it helps you to stay the course. It helps you to now like create an investment plan and a financial plan based on your why that is tailored to suit you as a person. So if I come tell you tomorrow, if you have like a solid why, like, oh, you know what, I want to give my children a better life, or I want to retire early, for me, what it does for me is it helps me question certain financial decisions and choices. So, say, for example, I want to buy a new car, right? I want to buy like a new car, and that car is going to cost me, let's say, £10,000, right? Now, knowing that I want to retire early and I don't want to always have to trade my time for money, ask yourself, like, this car that you want to buy, how is it going to take me a step closer to my goal, which is retiring early, right? And by asking this question, I now start doing the 5 whys, something called root cause analysis, where you do the 5 whys. After asking yourself 5 whys, you find the answer to your question. So you now start asking, okay, how would this car benefit me? So you now decide if you're buying the car because you want to use it as, for Uber whilst driving it for personal gain. I mean, what that means is if you're doing Uber, you're going to make extra income to invest. Or you could give yourself an excuse like, oh, I want to buy this car because if I buy this car, then I'm going to go to work earlier, and when I go to work earlier, my boss will give me a raise. Or you could say, I want to buy this car because if I buy this car, it's going to increase my reputation, and if increasing my reputation, it's going to bring more money to me. So there are various reasons. However, it's not left for you to pick the most feasible, genuine, correct, and true reason for you. So your why is very, very important, because like I said again, not like having a goal. When you know your why, it literally changes, like it's a game changer. So it helps you stay focused. You will not fall victim to Ponzi schemes anymore. I mean, for those of us that has lost money in one way or the other. Okay, so the next thing we're going to talk about is our risk profile, right? So when it comes to your risk profile, you have to choose and decide what your risk profile is. So we have low risk investors, we have medium risk investors, which is balanced, and then we have high risk investors, right? So when you understand your risk profile, you're able to now pick and choose investments based on your risk profile. And you're able to, sorry, one minute, I need to admit people. Admit. I don't know why I didn't remove this this restriction. Sorry, okay. All right, so when understand your risk profile, you're able to now pick and choose. Oh my goodness, I missed somebody else. Sorry. Okay. So you're able to now pick and choose investments that suits your risk profile. So generally, when it comes to finance, I always like to put like financial advice is broad, like it is very big. For you to actually know what works for you, you have to tailor it to suit yourself, which is why investing, like every other thing we do in life, is you have to be intentional about it. The same way you're intentional about waking up in the morning, showering, brushing your teeth, rushing off to work, paying your rent, making sure you pay your rent on time, your bills, everything. That is the same way you want to be intentional about investing and getting knowledge. Now, when it comes to risk, to your risk profile, generally it is assumed, or it is said that from the age of 20 to 45 to 50, well, some say 45 to 50, while others say 45, you're generally considered a high risk investor. Now, this is because you have time on your side to take bigger risk and to bounce back from any losses. You have strength and energy. I mean, some of us here, I know we have like multiple shifts. We do 1, 2, 3 shifts because we want to make extra income. So that energy, you have the energy. You're in good health because you're young. So generally, this is when it comes to the 3 stages of, so your risk profile is tied to the 3 stages of building wealth, which is accumulation, preservation, and distribution. So from 20 to 45 as a high risk investor, that is you're in the accumulation stage. So which is why I tell everybody that if you're between those age brackets, you're working hard, you're doing so many things, but you're not setting aside money to invest. Now, I'm not talking about saving. Like I said, savings will not grow your money, right? Unless you're very comfortable with the 2%. I mean, Nigeria has higher rates. Well, for the UK, we're talking about 3, 4, I think 5% at most, or 4% at most. So you need to invest your money, otherwise you're doing yourself a disservice. So the thing I see that people skip the accumulation phase, skip the preservation phase, and go all the way to distribution phase, which is pension. So another word for distribution is pension, right? And that's why people say things like, oh, pension is not enough. Okay, pensioners say, oh, my pension is not enough, or my pension is not. That's because they were docile. They didn't put their mind into it. They just contributed. I kept on giving money to a certain pension company. And I keep asking this question. Nobody will literally love you more than you love yourself, or literally want the best for you more than yourself. So even if you hire unless again you're very wealthy, right? Unless you have plenty money, that's something that they will be at your beck and call. But even if you pay for a financial advisor, or you give your money to like an advisory firm and all, you have to be fully involved. There's something called rebalancing your portfolio, because you would need to rebalance your portfolio if you want your money to grow and if you want your money to like stretch, basically. Now, for medium risk investors, it's assumed that from 45, again, some say 50 to 65, you're a medium risk investor. So this is the age where this is now the preservation stage, where all the money we've accumulated and invested, we are now preserving them. So if, for example, you used to invest in things like stocks, crypto, all those private equity. Now this is the age where you're like, okay, you know what? I can't afford to take much risk anymore because I don't have time on my side. Maybe I'm sick. That's age now where, I mean, some of our parents, they start having high blood pressure. So you know that they cannot take like certain movements in the market or shocks. That's when you now like start consolidating your investment and putting them in things like ETFs or dividend paying stocks or bonds, for example. Now, higher risk investor, so lower risk investor, that's the one that's like distribution stage pension, 65 to infinity. That's the age where we're now doing things like, high yield savings account, bonds, treasury bills, fixed deposits, because we cannot afford to take risk anymore. However, remember I said tailored to suit you. There are certain people in that category that still take risks. There are certain people in the medium risk category that still take risk. Now, speaking of your risk profile, you can be all 3, right? You can be all 3. You can be 2, you can have 2 risk profiles, you can be all 3. But I always say that whenever you want to open an investment account, or whenever you go to a brokerage firm, or whenever they ask you, Sha, what's your risk profile? Always say you're high risk, because what that means is when you say you're high risk, it gives you access to all these investments, like the low risk investments, the medium risk investments, and the higher risk investments. So then you can choose. But if you ever say you're a low risk investor, you're only going to ever have access to low risk investments, because they do not think that you're wise or knowledgeable enough to have access to this ones here, which is the medium and high risk investments. So when I say you can be all three, what I mean is you can be a low to medium to high risk investor, right? So for example, I am a super high aggressive investor. At the same time, I do low to medium risk investment. So what this basically means is how you allocate your money across investment classes. So let's say, for example, I'm a high risk investor and I have 10,000 pounds to invest today. Now, what I would do as Jennifer, high risk investor, will be to invest 7,000 or 8,000 pounds of that money in stocks and crypto. Now, that qualifies me as a high risk investor. I can decide to put the remaining 2,000 pounds in maybe a mutual fund or a fixed deposit or a high yield savings account. I am still a high risk investor with exposure to low risk investor. So you could call me a high to low risk investor, or better still, a moderate or balanced investor. So the same way I can say, okay, I want to reinvest my 10 pounds in a different way. I can say, okay, I'm going to put 5K in the stock market, 3K in mutual funds, and let's say maybe 2K in, bonds or fixed deposits. That makes me a high to medium to low risk investor. So you can literally spread your money across all three categories, which is why I say, always say you're a high risk investor. Then you can choose, because guess what? Your risk profile will change. Most of us, we are low risk investors because either we're not earning enough or we are scared, which again, if you're scared about investing, it simply just means you're not knowledgeable about it yet. Now, when it comes to risk versus reward, we know that the higher the risk, the higher the reward. Now, people get scared and say things like, oh, I don't want to lose my money. It's a high risk investment, right? So there are two things I tell people that determine what you're going to get from your investment. Number one is your attitude towards investing. Now, your attitude includes things like your mindset. Do you have an abundance mindset? Do you have a scarcity mindset? Are you greedy? All right. Are you content? Do you FOMO into things? Do you have knowledge? Are you acquiring the knowledge you need? Are you intentional about like getting investment knowledge? Are you sticking to your plan? So all these things are attitude and then time. So investment is a long-term horizon, like it's a long-term game, which is why I said like you can make a lot of money, but that is a benefit of being invested, not the reason why we invest. So it's a long-term goal. So you can say something like, okay, and the good thing about investing, especially with like your attitude and times, that you can calculate and determine the future time value of your money using compound interest, right? So when I say attitude and time, these are the two factors that we can control. You can control, and you can say, I'm not going to be greedy. You can decide to say, I'm just going to follow my investment plan. You can decide to say, I'm going to read today about stocks. I'm going to get as much knowledge as I can, or I'll dedicate 1 hour every day to getting knowledge. You can decide to say, I want to invest for 1 year, or, oh, you know what? I've changed my mind. I want to invest for 6 months, or I want to invest for 5 years. These are the things you can do. So this is what you can control. The rest, we cannot control it. So when it comes to investing, there are two types of risk. We have systemic risk and non-systemic risk. So non-systemic risk is the one that we can control, for example, diversification. So one key thing for you as an investor is you want to diversify your portfolio. So basically, simply means not putting your eggs in one basket. So you want to diversify across industries, across, let's say you invest in agriculture, you're investing in healthcare, you're investing in the banks, you're investing in oil and gas, defense, tech, AI. That is diversification. Then, so diversification protects us against, systemic risk, right? Non-systemic risk rather. So you want to diversify your investment. So think about Sorry, I think I'm going to ask that. So actually, I lost my train of thought. Okay, so diversification. So you want to diversify across industries, across investment platforms, across currencies, across countries. So for example, if you're buying a UK stock, you want to buy an American stock, you want to buy a China stock, you want to buy a Nigerian stock. So that is diversification across countries, which at the same time diversifies you across currencies as well. So diversification. While systemic risk is the things that we have no control over. So for example, COVID-19. When COVID-19 happened, everybody in the world suffered. Companies suffered, investment tanked, people lost their businesses, that would have never really recovered from COVID-19, right? So that is something we cannot control. Trump's policies, we cannot control it, and that has an impact on the whole world, right? However, certain systemic risk can affect location. Like it might not affect global, it might not affect the whole world. It can affect location. So what that means is if Trump makes a policy against China, for example, that not favorable to China, and you have China stocks, what that means is that in the interim, your stock will take a hit, right? But that does not mean there's anything wrong with your stock, but it might just take a hit. So you need to understand that there are two types of risk, systemic and non-systemic. So one, you have total control over. The rest you have no control over. So when I say diversification, think about it this way. Let's say you invest in a company that makes bikini, and then you invest in a company that sells umbrella. What that means is when it's raining, when people are buying umbrella, you're making money, right? When the sun comes out, when the rain has stopped, that's when people start buying bikini, right? Because they want to go to the beach and have fun, and you're still going to make money. So even if the umbrella company is no longer making you money, because again, it's the rainy season is gone, you're still going to make money regardless, because you're also invested in bikini, which is for the sunny period. So that's what diversification does. Now, speaking of attitude and risk versus reward, so there are two types of losses. There's two types of loss and profit. So we have unrealized loss. I was going to show you an example. Maybe I'll do that when we start the practical. So we have unrealized loss, and then we have final loss. We have unrealized profit, and we have final profit. So I'll give you an example. Meanwhile, is everybody following me? Any questions so far? I feel like I've been talking for a long time. Do we have any question? This is supposed to be an interactive class.
I don't have any questions. I don't know about others.
Thank you. I think we're over 20 in this class. Why is it just one person that is talking? What happened to the rest of us?
None.
Sorry, we're listening. I'm listening.
None here.
No question. Remember I said, if you ask me a question, I'm going to remember the things I probably might have forgotten, and anyway, double down on that. Okay, so like I said, we have two different types of losses: unrealized loss, final loss, unrealized profit, and final profit. Now, unrealized loss is most people, that's what most people make. So two things that make people lose money, investors lose money, is FOMOing into the market, being greedy, not having a plan or strategy, and mistaking unrealized loss for final loss, which is basically the outcome of everything I've mentioned. So let's say you buy a property tomorrow, for example, and you bought a property for 200K, right? Outright payment. That doesn't just use outright. And tomorrow, you hear that your property is now valued at 150K, no longer to the 200K that you bought it. However, remember, you still have your house that is still serving its purpose, right? Not like the purpose of the house has changed. Not like as property reduced in price, government came to tell you, okay, since your property is now worth half of the money, or more or less than half, or like 70%, give us half of it. We're going to divide your house into two. Like no such thing will happen. But however, it's not worth £150,000. That is an unrealized loss, right? So what that means is the property can still go down to 100K, quite all right, even zero, if I'm being honest, right? However, the value is the property. The loss is an unrealized loss. Now, it is your attitude, which I mentioned, that determines what you're going to get. So What most people do is they panic and sell. What we investors do is we buy the dip, right? So when I say panic, it happens not just in property, but also in the stock market. People buy stocks, buy property, it drops, and they're like, oh my goodness, this property is dropping. And I don't know, I've lost 50K. Let me just sell. Instead of me to lose all my money, I thought I'm bad pass. Let me just sell and save myself 150K. And by selling, you've turned that loss into a final loss. So you've taken it from an unrealized loss into a final loss, which now brings me to the second thing I said we have control over, which is time, which is why investment is a long-term game. So if you do not sell that property, you've not made a loss. But then you have to give the property time to recover from that loss, go back to the original amount, and then puts you in profit. I don't know if that makes any sense. And the thing about great investments is that whenever it dips and it goes back up, it usually exceeds the previous high. Let's assume that the property was 200K or 205K before it started dropping. When it goes back up, it will hit 205, which when it comes to investing, something we call support and resistance, which is a resistance level before it started dropping, right? If it exceeds that 205, that's it. It's just going to keep going up. So, can minimize this. No, hi, sorry. Everybody, okay, yeah. Okay, so as I was saying, so when you sell your investment, okay, so when you give your investment time, you give it time to bounce back. So same thing when you make a profit. So let's say you buy a property for 200K and it appreciates to 500K. That is an unrealized profit. However, the reason why we don't talk so much about taking profit, even though I say take profit, right? But why it's like it's not a thing is because when you leave your profit, it helps you build wealth faster, right? So that's why we don't talk about like turning your
Sorry,
money.
hello. Sorry, hello.
I can
Sorry.
hear you.
Okay, so I wanted to ask a question. You
Mhm.
said something about when a stock is dipping, you buy while others are selling, you buy when it's on a dip. So I wanted to ask a question. When exactly can you eat while it's dipping? So it doesn't dip further and depreciate your
Okay, so to
the
answer your
value of
question, firstly, rule of thumb, you cannot time the market. You cannot time the capital market. So something we say, time in the market beats time in the market. So there are so many times, if you follow me on social media, so many times I'll be like, oh, this stock drops and I'm going to buy and I buy. And then you see me tweet again, like, oh my goodness, like, why didn't I just wait? So you cannot time the market. But at the end of the day, there's a strategy called dollar cost averaging, where you invest, you feed into like the stock market, you invest bit by bit, that gives you more value for your money. So when a stock dips, like you said, people could be selling and taking profits, yes. However, that's not the only reason why a stock dips as well. And usually we do not know. So it was something we call, so we just use the word pullback. So we wait for you pullback. So which now brings us to the next thing. You have to decide how much success is enough for you. You have to decide how much profit is enough for you. You have to decide when you want to enter, which is why I said like investment, you have to tailor it to suit you. So there are several times where let's say I put 1K in a stock and the stock goes up and does like 50% in a month. And I'm like, okay, I'm going to wait for this stock to dip and I'll set price alerts, right? Because again, you can set price alerts for like the range you want. So I set price alerts for various ranges. I could say, let's say stock is 100 and I want to buy, I could say, notify me when the stock drop below 100. Notify me when the stock drops by 5%, by 10%, by 15%. So I can set multiple alerts. That's how I do it. However, guess what? Sometimes the alerts never hit and I forget about it. And then one day I was like, oh, okay, let me go and check out this stock that I wanted to buy. And I see that the stock is now at 150 or 200. And well, I'm going to show you, but when it comes to investing, again, like I said, there's support and resistance. And usually when a stock breaks resistance, it's very rare. If it's a valuable stock, it's not coming down anymore. Like once it breaks that amount and goes up, it is not coming back down. So, which is why I said, Sometimes what I do is, even if I'm angry that the stock has growth, the stock that has good potential, I'll still put small money, because guess what? If even if you buy at 100, say for example 100, you feel like £100 is too high for you. Maybe you bought some at 20 and it gets to 100. Even if you buy at 100 and the stock goes to do an extra 50%, it is still something. If it does 100, you'll still double your money. So you really cannot time the market. So which is why having your own strategy is important, and researching and having conviction in the stock you're buying. I can buy a stock that is £700 per stock if I'm convinced that that stock will do 50% or 20% or even 30%, because guess what? There is no savings account that'll give you 30%, and there's usually no investment, genuine investment that offer you 30%. The only place you can get interest rates as high as 30, 100 is either in the stock market, the crypto market. Real estate probably, but real estate will take you 5 to 10 years for your money to double, that kind of a thing. Real estate is a longer route to that. So you really cannot, time the market. I hope that answers your question.
Yes, yes, yes. Thank you.
And another thing I wanted to say is the fact that not every high risk investment again means you will lose money, which is why I'm also like very keen on explaining strategies. So not every high risk investment means you will lose money. Usually with high risk investment, what usually implies at least 50% of the time is you need to give your asset time. I've seen people make some mistakes, like they put their money in the stock market, and they won't take it out in 6 months' time. Again, I said stock is a long-term investment. Don't get me wrong, you can double your money in 6 months. In fact, there's a lady I coached last year, where she's in my investment group still, and she came to me and she was like, oh, she wanted to buy a house. And that it was in London. She wanted to put £70,000, but she had £40,000. So the good thing about investing is I tell people like investment is like bring your own, I'll bring my own. So you bring your own money and the market helps you to multiply that money. The market gives you the rest. So she came and she was like, she wanted to buy the house, she wanted to make a down payment, but she wanted to pay 70K, right? And so, sorry, are you guys sending chats? Got it. Okay, so she wanted to pay 70K, but she had 40K. So she wanted to invest her money for a space of 3 years so that she would literally, make up 70K to invest for that property. And when she came to me, she was a low risk investor. And I was like, now, which is why I said earlier that you can literally calculate the future time value of your money through investing. And that's because we have two types of interest. We have simple interest and we have compound interests, right? So compound interest is the one that grows your money faster. We call it interest on interest. So when she came, she was like, okay, well, you cannot get this with a low risk, because low risk investments, again, you're going to be investing in cash ISAs, premium bonds, fixed deposits, government bonds, treasury bills. And in the UK, the most you can get, like I said, is 4 to 5%. Maybe unless you have a lot of money, they can maybe give you special rates for 4 to 5%. Now, 5% of 40,000 annually. Now, for a simple interest, because cash ISA is simple interest, premium bonds, simple interest, government bonds, simple interest, fixed deposits, simple interest. None of this gives compound interest. So 5% of 40,000 pounds is what? 2K per annum multiplied by 3, that's 6K. So she still needs what, about 30 something K to go. So we adjusted her risk profile. She became a high risk investor, and then we just did stocks, to be fair, just stocks. And at least 3 of the stocks she invested in did 100%. One did more than 100%. So basically she made, in fact, she doubled, I think tripled her 40K in a space of less than 2 years. Meanwhile, her goal was 3 years. And she was like, she wasn't going to buy property anymore, which is why I said again, you have to decide what success and profit means for you. I am not a property. Well, I'm trying now to become a property person, but I've never been a property person. Like, because I've seen firsthand, my dad was a heavy real estate investor. And there's one thing I know is that whether it's a house or land, or let's now you're doing land banking, but especially in a climate like Nigeria, even some places around the world, Real estate is a high risk, is a high to low to medium risk investment because you have capital risk, you're tying down your capital, right? It could go in a good way, it could go in a bad way, So we have cases of natural disaster that's under risk, things like flooding, fire, things like that. So she decided that she didn't want, because according to her, going to take her 5 years or more to make the kind of money she made in the stock market. And that benefit of stocks is that it is very liquid. It is a liquid investment. Real estate is not so liquid. Like I said, you're tying down your capital. And if you wanted to sell today, it will be difficult. Even if you want to pull out equity, you need to hold a property for like a number of years. Hopefully it appreciates enough for you to be able to draw down equity. Okay, keeps showing me that people are in the waiting room, but okay. And it's I should have literally just disabled this join. Hiya, Carol. Hiya, Building. I'm so sorry. For some reason, I did check earlier, but I couldn't see your request anymore. I don't know if they can hear me.
Hello, Jennifer. Thank you
Hi,
for
I'm
having
so
me.
sorry. But the call is recorded, so you guys can watch and catch up later.
Okay, thank you.
You're welcome. Okay, so the benefit of knowing your risk profile is, again, it gives you access to lots of investments and you can pick and choose based on your risk profile. So before you actually determine your risk profile, I know like we said, generic from 20 to 45, you have to be high risk and all. You need to consider your age, your income level, your health, your job, your career progression. Do you have any dependents? Do you have anybody that is sick that is depending on you? How many children do you have? How many children do you plan to have? Because guess what? The way you invest as a single person is not the way you're going to invest when you get married. The way you invest as a low income earner is not the way you invest if you're a high income earner. So you have to factor all this into, because I always like to say, like for me, I'm a high risk, but I can invest my last card and be hungry, right? And be looking at the ceiling. But why? Because it's just me. I don't have black tax that much. I don't even have at all, let me be honest. I don't have black tax. Nobody's looking at not married, no children. Nobody's going to draw me and say, Mommy, I'm hungry if I don't give them food. So it's just me. So I can afford to take such high risk and put my money in places where I now not access it for, let's say, 3 years or 2 years, So you have to factor in this. However, like I said, remember I said it is tailored to suit you. I have seen people that are low income earners that have lots of responsibility, take high risk, and it's paid off. Well, the ones I know paid off, which is very weird. I think it's only one person. Not like that one, not like it didn't pay off, because again, remember I mentioned unrealized loss. The only thing was that the person did not have enough time. That was the mistake they made. So you can, just like how I said that there are old people that still take risk. For example, I mean, if you read Elumelu's book, you understand like a little bit of that. So types of investment are available to you. Stocks and shares. So stocks and share is the same thing. So basically you're buying a piece of a company. So you becoming a shareholder of companies, global companies around the world, local companies even. So when you buy a stock of a company, guess what? If Warren Buffett has 100 million in that company and you have 200 pounds in that company, when they are calling for shareholders meeting, they will send him an email. They'll send you an email. The only difference might just be that maybe they're going to use convoy to go and carry him from his house, while maybe you join online, or maybe you trek to the place, right? But they're going to send him an email. They'll send you an email. You have a right to vote as much as he has a right to vote. Now, the only difference is maybe he has more voting power than you. But guess what? I don't know if you guys watch movies. Something I find very interesting about movies is even a 0.5% share can prevent someone from taking over a company. So that goes to show that even your 0.5% share that you bought for, let's say, 100 pounds or 200 pounds is valuable. Now, unless, which most of us in this part of the world do, we do not exercise our right to vote in this foreign company. That's something I'm actually being more intentional about doing, right? Because when it comes to how a stock behaves or how your investment behaves, one of the important factors to look out for is who is the leader? Who are the leaders of this company? That plays a huge role in how the company is going to grow. If you're going to make money, you're going to lose money. So, which is why I said even a 0.5% can literally prevent someone. So if you watch all those movies where they're looking for the person that has the share, they're not going to offer the person that, oh, we are willing to buy your share for $200,000. You know, so yes, that happens. I've not seen it happen in real life, but I know it can happen. And then we have index funds and ETFs, which are also stocks, basically. So, well, index funds are, I'll explain that. So ETFs are exchange traded funds. So think of ETF like a basket of stocks. So let's say a basket of fruits, that if basket of fruit that has apple, pawpaw, pineapples, oranges, that's what an ETF is. It's an exchange traded fund that has multiple stocks in one. So it is low cost, it is diversified. You know, the most popular one we have is the S&P 500. That tracks the top 500 companies in America. In the UK, we have the FTSE 100 that tracks the top 100 companies in the UK. So that's what an ETF is. So an index fund is similar to an ETF. It's also even similar to mutual funds. Difference is with index funds, you know, you could buy multiple investments. So an index fund can have, let's say, commodities, you know, stocks, companies in it, and you can only trade index funds once every day on the market, and it is also actively managed by fund managers. ETFs are managed by fund managers as well, but not like hands-on like index funds. So usually index funds have a little bit higher fees compared to ETF, but they are similar because you're buying multiple investments in one, which saves you the money. But what I always tell people, well, now this is my own, because I mean, this class you're paying for my knowledge and what has worked for me and everybody that in my community. So what I tell people is, for us, for me, index funds and ETFs, I use that as my savings account. So I don't save. Remember I said savings not real money. I don't save my money anymore. So I put my money in index funds or ETFs, right? But to build real wealth, I invest in individual stocks. Now, this is because in as much as we say ETF, so when you're talking about ETF, no, this is the same thing, like contribute £200 every month consistently, and by 25 years, you have 1 million, and hence ETF can give you that kind of goal, right? That kind of vibe. But for me that don't want to wait to 25 years to have 1 million and, you know, enjoy myself, that's why I go for individual stocks or growth stocks. So the thing about ETF is that it caps your growth, right? And it caps your losses. So you know how I said you can calculate the future time value of your money through investing. So let's say you set the goal for yourself. Say you want to hit £100,000 in 10 years, right? Now, if you have individual stock now, for example, imagine I had said I wanted to hit 100K in 10 years. And because PLTR has given me 500% return this year, IUNQ, oh my goodness, over 500%. Netflix, about 100%, 70 thereabout percent. APLD has given me almost 200%. So now imagine I said I wanted to get to 100K in 10 years. By the movement of these stocks, my 10 years has reduced. If I'm not exaggerating, to like 4 years or 3 years or 5 years, let's say max 5 years, because it's giving me that much growth, which is why I said you can make so much money as an investor, but that is a benefit of being invested. I was able to make this much growth because I am an investor and I invested in those companies. So that's a benefit. So with ETF is like pizza, it's like a pie. So you know how you order pizza from Domino's and they cut it into 8. Some parts are bigger, some parts are smaller. That's how an ETF is. It's a pie of 500 companies. So obviously some parts will be small, some parts will be bigger, right? And the thing about ETF, and that thing you guys should write down, pro tip, is always look at the weightage or the weightings of an ETF before you buy it. Because one thing you don't want your investments to do is to correlate. So you don't want to buy the same investment. So, and people usually mistake that with ETFs a lot. So index, for me, I said index funds are different. But the thing about index funds is index funds can track an ETF. So for example, you can buy the S&P 500, right? And then buy an index fund that maybe has a different name, but it is tracking the S&P 500. So what that means is, however this S&P 500 moves, that is how that index fund will move. So if your S&P 500 loses money, the index fund will lose money. If S&P 500 grows by 10%, the index fund probably grow by 8%. So you don't want to buy the same stock. Actually, people make this mistake with ETF and index fund because there's something called tickers, right? Tickers is the abbreviation for stock. So for example, Amazon is AMZN, Tesla is TSLA. So for individual stocks, no two companies has the same ticker. So it's very easy for you to differentiate. But for ETFs, two ETFs can have still different tickers. I'm not joking, but they'll still have like the whole how do I put the whole ETF name attached to the ticker, or they might have completely different tickers. But guess what? They'll have the exact same stocks with the exact same weightage. And then you see somebody will buy SPDR, they will buy SPY, they will buy S&P 500, they will buy how was the name of this one again? Oh, VUSA, they will buy, and all these stocks I'm mentioning are literally the same thing, but with different names. So pro tip, you don't want your investments to correlate. If you're deciding you want to invest in ETFs, you want to focus on, you want to focus on, the weightage of the ETF. So like I'm saying, so ETF is like a pie. So every stock is little. So if, for example, this S&P 500 has 4% out of the overall 100 of the pie, it has 4% Tesla, right? If Tesla does, let's say, a dramatic 1,000% return, the ETF would, benefit from that, but your growth will not be as high as those that had individual stocks of Tesla. So someone that has 1K in Tesla would make 10,000, pounds. Whilst you that have an ETF, you probably make just a couple, just like you still feel it. That's the same way it caps your losses. So I always tell people, like, if you want to build wealth the slow and steady way, then of course, by all means, ETFs. If you don't have the energy, the time, you don't know, you cannot be intentional to research stocks and all, ETF and index funds are your best bet, and mutual funds as well. So they are basically similar. Then we have bonds. So government gilts, UK calls it gilts. US calls it bonds, Nigeria calls it bonds. So we have bonds, that's types of bonds. Bonds could be issued by government or companies. Think of companies like Facebook, MTN, even countries issue bonds. The good thing about bonds, especially government bonds, is it is super low risk. It is backed by the full faith and credit of the issuing government. So what that means is if anything goes wrong, even if the economy crumbles, the government is obligated to go and print money. They'll go and print money and pay you back. Now, for that security, the interest rate is low. Again, Nigeria is the only country where bonds have high interest rates, right? So you guys might want to take advantage of Nigerian investment. So normally, the interest rates of bonds are low. That is the cost of that guarantee, which is why I said the lower the risk, the lower the return. The higher the risk, the higher the return. Corporate bonds as well are companies. So usually as well, it could depend on how they issue the bonds. And so a company called credit companies and how it is rated, it could be either low risk or high risk. Real estate, again, remember I said I'm not really huge on real estate. So I just did buy to let and my favorite, which is REITs. So REITs are stocks in the stock market. You could invest in real estate in the stock market. And I love REITs because they are one of the highest paying dividend stocks in the stock market. And this is because they are mandated by law to pay out 90% of their interest to investors as dividend, to shareholders as dividend. So which we can see REITs that pay up to 20% on the market. Again, that's dividend income. Now, when it comes to stocks, there are two ways we make money off stocks. Capital gains, that's when your initial money, the initial investment amount increases, and dividend payments, where you get paid dividends for being a shareholder, like a return. So when you invest in REITs, you're earning that high interest. Some REITs pay dividends monthly. I mean, most stocks pay dividends monthly, some pay quarterly, some pay biannually, right? So when you're getting paid these dividends, you're also benefiting from the gain your money is going to make. The only thing is REITs don't grow as much as growth stocks, but you will still enjoy the capital gains. Now, premium bonds, this is the same thing, similar to bonds, but for those of us in the UK, premium bond is the one where you can invest your money tax-free and you can win prizes. I know someone asked me about it, that's why I added it here, but usually I don't recommend it. I feel like it's gambling because your money is not growing. So, although I know someone that won £10,000, very funny story. Yeah, so that's what premium bonds are for. Savings are cash ISA if you're a low risk investor, or you can put your emergency fund here if you want to. So they are tax-free interest, safe options for you to invest as well. But again, your interest is going to be low and it is annually. Cryptocurrency, high risk, high reward. Pension and SIP. So if you're working, you want to check out pensions, see if you can consolidate your pension, move it elsewhere. See if you don't have an employer's pension, you want to ask for one. If you're a business owner, you want to also have a self-invested pension. Even if you're working as well, you want to have self-invested pension. And that pro tip I tell people is like, if you're also working, especially for those of us that do tech, high-paying jobs, one way to save on taxes is to apply to your pension, is to ask for salary sacrifice. Yeah, so I want to do more research on that salary sacrifice. That's a pro tip. Okay, so quick reminder, actually for those of us that are going to be participating in the practical, we don't need a lot of money to invest in the stock market. You don't need to borrow money. Like you don't need plenty salary, right? So short term, setting your investment goals. Short term, 1 to 3 years. This is where you put your emergency funds. You could say things like, okay, I want to travel in 2 years, or I want to buy a house in 2 years. So this is what short-term goals are. You can put your money in high yield savings, bonds, money market funds. Now, you can still put your money in the stock market. Remember I said it is up to you, right? After you decided your risk profile. Speaking of which, I'm assuming that we all, as I'm having this call, that we've all in our brain done a little bit of brain work to determine our risk profile, because that is going to be very important in the practical stage of the class. Have we all? I don't want to get someone not telling me, oh, I've not decided my risk profile. When did you say that? Do we all understand what your risk profile is? Guys, come on.
Yes.
Yes.
Okay, thank you. Okay, so yeah, the medium-term investment, 3 to 10 years, these are like things you could do for house deposits, education, business expansion. So you could do stocks, ETFs, bonds. However, now this is again general. When I started, I used to have short-term, medium-term, long-term goals, but I stopped, right? And that was because I realized that if when we're doctors in economics, right? Scale of preference, that's number one, and human needs are insatiable. I think we all learned this in school. So I realized that not just for me, even as I've coached people, I realized that when we have multiple investment goals like this, short term, medium term, and long term, our longer term goals tend to suffer, because we all want quick, again, that's a quick, what do you call it, pleasures and gratification, which is why they said delayed gratification is very important. So we all want quick. So you see people focusing on things like buying a house first, buying a car, traveling the world, having an expensive. So it's not everybody that is disciplined enough to have these 3 goals and, follow them up accordingly. For some people, this one here suffer because they always think, oh, I have time and I still have a long time away from retirement. I still have a long time away from wealth building, so this suffers while they focus on this and this. So oftentimes just this one. And from what I know is whenever they tick off something from their short, let's say they tick off the emergency fund, you'll probably see they'll not add travel. When they've ticked off travel, you're not come and see a new car. So when they tick off a new car, so something would always come up, which is why I said human needs are insatiable. So for me, what I just did is, like I said earlier, one goal, retire early. So when I want to spend my money, I always ask myself, how is this money you want to spend? How will it take you closer to this goal, right? So whether I want to travel, whether I want to buy a house, whether I want to move to a new country, whether I want to get a job. So whatever it is at all I want to spend my money on, I do the brain work. I ask myself, how will this take you closer to your goal? So as an investor, one thing I tell people is like, every money you spend, and I say this with all honesty, because that's what I do, should give you some sort of return on investment, tangible return on investment. It doesn't have to be immediate. It can be in the nearest future, but it should give you some sort of tangible, return on investment. So, which is why when people say things like, oh, this person spent millions of dollars to maybe rent a house and host a party, people will be like, oh, that's so wasteful. You don't know what they've seen or what they want to make out of that money that they've spent. So everything you spend, it might look stupid to somebody else, but it should give you some sort of return on the investment. I know somebody that would, like, if you see he doesn't even have a car to even start with. Like, if you even see the way he dressed, you think he's like the poorest of the poor. But if you go to his house, when he travels, business class, and you know he has money. But you see the phone he uses, he can't be bothered. How he appears to outsiders, he cannot be bothered. So that's what I call value-based spending. So it's value-based. So you want to make sure that whatever you're spending your money on gives you some sort of return on investment, even if it's not now, in the future. Second tip, again, as an investor, news is not just news. So you watch the news or you hear Donald Trump has said this, Buhari has said, sorry, is it Buhari or Tinubu? Tinubu has said this, UKVI has said this. All those are news, right? But news is not just news, which is why they say things like in every economy, no matter how hard it is, there are people that are still making money. So just by listening to the news, you can know what to do, where to invest to make more money. Because guess what? No matter how bad the news is, there are sectors and industries that are making so much money from that bad situation. Just like when COVID came, so many people made so much money. There are companies that made a lot of money during COVID. So no matter how bad, even during the war, as there is war, I'm a Christian, so God please forgive me. Like, even though like we don't like the war, or guess what? The rich men, that's how they get richer, by sponsoring this war. So I'm not supposed to talk about it, but that's just like something. So no matter how bad the situation is, as an investor, your goal is to be able to make money regardless, right? And it is possible. Okay, so 10 years ago, let me like shake us up a little bit. Even though 10 years ago, how old was I? I mean, to be fair, I was quite knowledgeable. I started investing then, but I don't think we even had where to buy, where to buy what do you call it, for American stocks in Nigeria. We didn't have such platforms. So again, I don't think I even knew what Tesla. I knew what Tesla was, but I didn't know how to invest or anything, to be honest. So with that being said, I didn't buy Tesla at 14. However, I know I bought Tesla at, I think, 100 or something before I did the stock split. So if any of you here magically got Tesla when it was $14 10 years ago, and today you'd have made 44,000. It's actually higher now, to be fair, because Tesla did a dramatic rise this period. So it's actually higher. It should be like maybe 6-something thousand, 15,000 right now. But that's how much profit you've made. So imagine that you put 1K in this stock as at that time, or that you put 2K. Or let me just be dramatic and say 10K. Can someone calculate how much that would be times 44,429% return on investment? Because $14 10 years ago is worth 6K now. Now remember, I said Tesla did a 10-for-1 stock split. So stock split is something companies do to make their stocks affordable and appealing to customers, especially beginner investors. So Tesla got to, I think, 2000, was it 2000 or 1,000? I can't remember again. I think 2000. And I don't know, someone correct me if I'm wrong or do that research, but I know it's between 2,000. And
It was
then
1,000 plus.
8,000 plus, right? Not 2,000. I know
Yeah.
it was between thereabouts. So, and then they decided that, okay, you know what? Our stock is too expensive. We don't want to scale off investors, try to beginner investors. Let's do a stock split. And so they did a stock split, thereby making the stock attractive and affordable for investors. So I think when they did that stock split, it drops about 100 plus, then it went up to 200, 300, 400, dropped again. I think now it's chasing the 500. So when you see Tesla, so if not that Elon Musk is everywhere, which is why I mentioned that when it comes to choosing a stock or an investment, the leader is very important. Because why would he not go and focus on his business? He's doing politics. Not that his busybody is into politics. Tesla should, this is actually the original price of Tesla, 6,006 something, right? Like Tesla should literally be there. So currently, I think it's about 400 and something, which, if we are being realistic, is 4,000 plus. That's actually the original price of Tesla. So this is the return we would have made if we had bought Tesla 10 years ago. So if you had said that 100,000 pounds 10 years ago and you had bought Tesla, I'm sure you'd have hit it by now, if not more. Amazon, well, 10 years ago, $15. Fast forward to today, we can see the return is made. Nvidia, it's no longer $1,288 though. Currently, it is 1,800 something, if I'm whatever or something, if I'm correct. So, which means this 268,000% you're saying is way more than this. So the bottom line is invest your money. Okay, so how much money am I leaving on the table? I mean, for those of us that use Amazon, like Amazon, I tell people like Amazon is, I feel like the company is just playing with us, right? But it is one stock that I know that when it takes off, it's really going to take off because they've bought Twitch. You guys know Kai Cenat, right? The famous streamer guy. So they bought the platform that Kai Cenat uses to stream. However, when we talk about things that affect stock prices, we have acquisitions, we have leadership, we have global policies and all, However, that particular acquisition did not really have that much impact on the share price, at least not yet. Let's also maybe delayed impact, right? And I think, again, that had to do with his split with his ex-wife, which is why I said the leadership is very, very important of a company. But does that take away from Amazon being a great company? Hell no. We all use Amazon. Millions of people around the world use Amazon every single day. Either the delivery, the website, you're ordering something from the website, you're watching Prime, you're using Amazon Music, you're talking to Alexa, you're streaming on Twitch, or you're watching people streaming on Twitch. Literally, this is how this company makes money. For companies, they have the AWS cloud. So Amazon is a B2B and a B2C company. So which is one of the key things you also want to ask yourself when you're looking at companies to invest in. Is it a product-based company? Is it a service-based company? Is it B2B? Is it B2C? So literally, what do they do? What is their moat? What is their mission? What's their vision? How do they compare to their competitors? These are things you want to research when you're literally choosing stocks or companies to invest. So it's a $2 trillion company, one of the top 5 largest companies that exist. Yeah, that's that. So major types of stock, generally growth stock and dividend stocks. So what are growth stocks? So growth stocks are stocks that can 10x your money real quick or 100x your money real quick, like we've seen. So all the stock I listed in the previous slides are all growth stocks. So think of Tesla, Google, Amazon, Nvidia, PLTR, Netflix, Broadcom, CrowdStrike. All these are called growth stocks. Why? Because they could not be bothered about paying us dividends. In fact, I don't even want them to pay me dividends, right? So they could not, so most of them usually do not pay dividends. The ones that do pay little, like very little dividends. And usually this is because growth stocks take more risk. They reinvest their money, their profits heavily back into the company. For those that have R&D, development team, research team, you see they reinvest heavily. That's why if you check out most of the popular things we use today, which can be classified as growth stock, they all have AI. Because one other key thing you want to look out for when choosing a stock is how do they adopt technology? Are they early adopters? So if you go on WhatsApp, say WhatsApp has AI, Facebook has AI, Instagram has AI, Microsoft has AI, Google has AI. So every single growth stock, say they have AI. So which means they cannot snooze, because any of these companies that are just literally chills or snoozes, they're going to lose out, on this money-making thing called AI. So growth stocks are stocks that literally grow at a rate significantly above the average growth for the market. So they generally do not pay dividends. So although some of them do pay little dividends. So they use all their earnings and resources and profits to expand their products. So while dividend stocks are stocks that literally their main concern is to return profits to their shareholders, right? So for example, a REIT stock I mentioned earlier, Real Estate Investment Trust, they are dividend stocks mandated by law to pay out 90% of their profits to shareholders. Other dividend stocks are usually consumer staple stocks. So consumer staple basically means companies that produce the things that we need every single day, or the things that like human beings need, right? So those are dividend paying stocks. So their focus is to return investment. So they could not be bothered about taking risks. However, they do grow as well, which I said, you can make money in two ways: capital gains or dividends. They do grow. However, they grow at a much slower rate compared to the growth stocks. Yeah, so I think I've talked about this one. So now, what is important to know about a company? And this applies to every investment at all. Oh my goodness, is it just me, or do people are entering multiple times? Okay, so CEO, team of the company. So there's one thing I always say, like, if you're confused, ever say you're a beginner, you don't have time to research your company, invest in stocks that are backed by products, services, and people. So for example, Apple products, we have MacBook, iPhone, iPad, AirPods. For their services, almost everybody that has an Apple phone subscribes for Apple Music, right? There's Apple Music, there's Apple TV. For Amazon, for example, Apple is a B2B, a B2C company. I think it's also a B2B company. Amazon is a B2B, B2C company. It also has products and services. Think about Alexa. Think about like the services like the Amazon delivery, Amazon Prime, AWS Cloud. So who is their CEO? Who is their team? What is their growth strategy? So if it's a company that pays dividends, you want to know, how has their profit been year on year? Have they increased their dividend yield, or have they reduced their dividend payment? So dividend yield is basically percentage and interest you earn on a dividend stock. So for example, a stock that says our dividend yield is 6% means that annually that stock will pay you 6%. Then there's something called earnings per share that works hand in hand with dividend yield. So your earnings per share simply means, like, let's say, for example, you buy a stock at $100 or £100, and that stock pays you £5, right? So what that means is that for every £100 of that, or you invest in that stock, you get paid £5. So I think by the time you divide it, your yield is basically just 5%. I'll probably send calculation later. Yeah, you divide the multiply by 100. So literally your yield is 5%. So what this does for you is, if you want to invest for income, for example, you have to check the yield, right? What is this stock paying me? For those of us that want to retire early, that want to earn passive income, you're investing for income. You want to check the yield. You want to check the earnings per share. You want to check the history of that company, how they've been growing, right? So what this does for you is, it also tells you if that company is beating, if that yield is beating inflation. If inflation is at 5%, you don't want to invest in a company that's giving you 5% yield, because what that means is that return is at par with inflation. You maybe want to go for a company that's giving you at least 7% yield or 8% yield. You know, it does, so again, so that you don't also mistakenly invest in a stock that is paying you 3% yield. I mean, it doesn't mean that it's bad, right? So, and that thing you need to also know as well, which is why you actually have to do your research and be intentional like that. Not every stock that pays high yield is a good stock to invest in. So some stocks or some companies might be in problem, like have problem. They might want to either dilute. So when companies dilute their shares, this is more advanced, but it literally reduces the value of your own share, or the value of total shares of shareholder. So usually companies like that, they might increase their interest rates, right? So what this does is, you can just be going, you might just see a stock and say, oh, we're going to pay you 20% per annum or 25% per annum, as in dividends, right? And then you find out that that is not a good deal, because it could mean that the company is in trouble. So they're trying to raise more funds to either build themselves out or to do something. And what this does is, it affects the actual price of the stock. So you can buy that stock, let's say, for example, at £100, and they offer you 20% interest. interest, and then you find out that in 1 year, the 100 pounds is not worth, let's say 10 or 15 or 20 pounds. Now, again, that's an unrealized loss unless you sell. However, if it's a company that is in problem or in trouble with no actual game plan of coming out of that problem, then it's a problem, right? Unless, again, like I said, you have so much time to ride it out. You're willing to, you're willing to write it out and see, especially if it's a company you believe in, which is why you need to have knowledge and have that conviction. So what is the growth strategy? So for example, NVIDIA, that's like the most valuable company in the world right now. It is richer than some countries, right? They have beat their earnings consistently back to back to back since last year. They have not missed an earning. Like, like a company can say, okay, we are set to make $10 million this year in profit, right? And if they make 9.999, they miss their earnings. And these are the kind of things that can make a stock price to drop. Now, it does not mean that the company is less valuable. It's just investors reacting, or the market reacting to that missed earnings. Then if the stock makes 10 million, it means they met their earnings. If it does 10.1 million, it means it beats the earnings, right? So NVIDIA has constantly beat their earnings like back to back to back to back. So competition. So you want to know the company you're investing in, how does it perform in relation or in comparison to its competitors? I remember
Sorry to cut you. Someone is in the waiting room.
Yeah, I was
waiting.
pressing. Thank you. So I remember like when I was doing my project in university, like my master's, and my topic was like to compare Tesla and BYD, like the two EV vehicles, two EV companies. And when I was doing that research, I realized that when I was looking at the charts, certain market news, industry news or trends that affected like smaller EV vehicle companies like BYD, NIO, Rivian, all those EV, like all those news where the government to say something crazy and you see our stock price would drop, it never really affected Tesla as much. Now, when you see that kind of thing or that kind of chart, you now want to ask yourself why. What makes Tesla different from the rest? So these are the kind of things you want to look out for, comparing them to their competition. Then their financials. What is their market capitalization? So market cap simply means how the company has been able to penetrate the market. So think of Netflix, for example. That is one of my favorite stocks when I want to give market cap, because that company has wowed me, right? It's crazy because last year, no, was it early this year when the tariff thing was happening? It was around $500 per share. Fast forward to today, it's $1,200 per share. That's insane. Like, so Netflix, why I say market cap is because they have penetrated every single country. Korea, India, Nigeria, Ghana, South Africa, America, United Kingdom. Netflix is everywhere, so much so that it is no longer considered, in fact, I don't consider it a streaming platform anymore. I thought like Netflix is a distribution platform, just like how Instagram is not just social media. Instagram is a distribution platform. TikTok is not just social media. TikTok is a distribution and a shop. Those are the kind of things you want to look out for in companies. Guess what? When it comes to financial, you need to know how many income streams they have. Which is why I said you want to buy a company that is backed by products or services, because they have more than one income stream. So Netflix distribution, that's why, for those of us in the UK, you see that your Netflix now has ads. Why? Because companies have seen that Netflix is everywhere now. So they are saying, you know what? You have our target audience. We don't mind paying you to be in front of these people that use your platforms every single day. So for every 10 people that are streaming movies in their homes, at least 7 or 8, they're streaming with Netflix. Right. So which is why you see they have live events and things like that. So when it comes to financials, you want to check out their market capitalization, their net asset value, what is their profit margin, like how much they make, what is their gross profit, what is their net profit, right? So after they're taking out their expenses, expenditures, taxes, employee salaries, money they used to produce their products, if it's a product-based company, how much profit have they made in total? Now for dividend paying stocks, something we call dividend cover, right? Dividend cover simply tells you the ability of a company to pay you dividends 2 times over. So this works together with the profit. I say how much profit have they made. So when a company has a dividend cover of 1, that means that they can only afford to pay you dividend 1 time. So if anything goes wrong and they don't make enough money to pay you dividends, they might not be able to pay you dividends, or they will adjust it and pay you lower dividends. That's why when COVID happened, most dividend paying companies that were not consumer staple companies or discretionary, they had to stop paying dividends. For example, entertainment companies, hospitality, because they were not making money from anywhere. But if a company has a dividend cover of 2 or 1.5, 2 is usually the highest. Have I seen a 3 before? I'm not sure. I think maybe 2.5. What that means, they can pay you their dividends 2 times over, even if they make enough money the next tax year or not, because they have a dividend cover of 2. So they have a lot of reserve, which is one thing you also want to check. But do they have cash? How is their cash? Because cash is king, whether you're further for you as a person or for an investor. You want to know, do they have debt? Do they have any strategic partnerships, mergers, acquisitions, collaborations? These are things you want to look out for in financials. I mentioned cash on hand. Then analyst reports. We're going to see all this like when we do the practical part. Analyst report, very important. You want to know what the analyst are saying. So there are 2 types of investors. We have retail investors, you and me, and then we have institutional investors, the big guys. Think of them: HSBC, BlackRock, Blackstone. These are people that have the liquidity. They're those that can invest $10 million at once in the company and pull it out, right? So, and usually each of these companies have analysts, and they predict, or they tend to know how a company is going to move, usually because they usually always have insider information. So they're able to predict, all this movement and all that stuff. So you want to look at the analyst report. That is very, very important. Now, speaking of what can affect price, like I mentioned, so when the market, I would like stock market is just like a marketplace where people come to buy and sell. I'm going to show you that as well. So on some days, there could be lots of buyers. On some days, there could be lots of sellers, right? And this volume has an impact on the stock price. The fact that the stock price drops does not mean that anything is wrong with the company. It could just be people are taking profit, or analysts, for example. If someone that puts 100 million, for example, in the company, and the company grows and does 500%, they take out their profit because, of course, they want to return dividends to their shareholders, right? What do you think will happen removing that kind of huge amount of money from the market? It will tank. And that's also one of the benefits of the market being very liquid, which is why I love the stock market side. In stocks, if you make $100,000 today, and you say you want to sell your 100K and collect your profit, you will sell it and you get your money that same day. So these are things like you need to know. Okay, so how do I know what to invest in? So my favorite tip is buy the things you use. Buy the brands you're loyal to. You know how when we're in Nigeria, we say things like, sardine, how many sardine used to be 4? And they'll be like, oh my goodness, I bought sardine today. It's no longer 4, it's now 3. Or I bought sardine today, no longer 3, it's now 2. Now imagine you're an investor and you love sardine. Like I have a friend that loves sardine so much. And you buy sardine, you invested in sardine, you buy sardine. And sardine has always been 4, right? The day you buy and it is 3 or 2, you start becoming suspicious. As an investor, you'll be like, is something wrong with this company, right? And what you want to do is maybe go and research and see, why did sardine reduce from 4 to 3? Are they having issues? Do they need more money? Are they trying to cut on expenses? So good thing about investing, the things you know is it is easier for you to literally spot trends and know when to buy in and when to pull out. So let's say, for example, you invest in Nike and you love Nike so much, and realize that about last time Nike released a sneakers that was a hit. It's been ages, So usually what can this do? It can affect the stock price. Or maybe you buy Nike, for example, and they come out and that, oh, the shoe that they brought out, they all have issues. They want to recall all their shoe collection. What do you think this would do? It will have an effect on the stock price, of course. So investing in things you do is one of my favorite, not only because you can easily find out when there's problems, but because the same way you're loyal to this brand, that's the same way other people like you are loyal to this brand. So what that means is they have their own clientele and they are always going to make money and profit. Right. So what clothing designers do you buy? I thought, but you know that LVMH owns YSL, Louis Vuitton, Christian Dior, Hennessy, like that's one parent company, right? So you're going to YSL, you buy YSL, but go to the it's literally one company that owns all those brands. What electronics do you buy? Apple, Samsung, LG, toiletries for us ladies that we can be loyal to a skincare brand or something. You know, what detergent you use, what toiletries you use, the medicine you take. Everybody has paracetamol in their house. I know I do. I have paracetamol, I have Panadol. What stores do you always shop at? So most stores are classified under the REIT stock. So REITs are companies that lease out their real estate, like I mentioned earlier, or manages it. So think of stores like Tesco, Sainsbury. We have REITs in Nigeria as well. But I'm trying to remember the name of Nigerian REITs in the stock market. So Tesco, Sainsbury. I know that recently Sainsbury has been managed by a REIT, and that REIT wants to buy them out. However, I don't know if they've finalized that buyout. So what stores do you shop at? What foods do you always eat? What beverages do you drink? What apps do you always use? So for me, I cook with Okomo oil, and I have Okomo oil share, like red oil. So what do you do for entertainment? So this is like a very simple way to invest, right? And that thing I wanted to know, important to know, thank God I saw this, is whenever you also want to know more details about the company, every company, as long as the company is listed on the stock market, whether it's an American company, a Nigerian company, a UK company, they all have an investor relations page. As an investor, this is where you go to on the website. Just search for the company. You can search for Apple Investor Relations or Rolls-Royce Investor Relations. The page will come up. This is where you learn more about what the company is doing, how much they've made, what plans they have for their future, and for you as an investor, and determine if they have what it takes to make their business grow. Then I mentioned all this. For REITs, you want to know the number of properties they own, tenant information, strength of the same, dividend history. I mentioned this part. Okay, so this is my morning today. I don't know if it's your morning. I just try to make it like a little bit easier. iPhone, wake up in the morning, you pray, check your phone. I mean, I have an iPhone, I have a Samsung. Google, check your email. Google is a stock you can buy. Apple is a stock you can buy if you use an iPhone. Instagram, right? Instagram, Meta, even Zoom that I need to make this call. You know that Zoom made so much money due to the pandemic. That was when it literally became very popular. Zoom, right? So Instagram, for example, the parent company of Instagram is Meta. They own Instagram, Facebook, WhatsApp, Threads, and currently, I know Mark is working on heavily on AI and virtual reality, which is going to be a hit, right? And then you brush your teeth. What company makes the toothbrush you use? What company makes the toothpaste you use? The toilet roll you use? The water you drink? Your detergent? If you're someone that goes to the gym, you probably wear Nike. You know, the granite oil you make was made by a company. So, for example, like another brand example, like when you shop from Zara, I know Zara owns H&M, Stradivarius, Bershka, Gap. You know, when you buy Crest now, and then you see what's the last the Colgate, right? And then you think, oh, it's a different brand. Like they're owned by the same company, right? But they just make different products with different names to create that competition, and that's how they make money. Which is why I love consumer staple goods, because they are quite good when it comes to their strategy, and that's how they make the money that they pay to shareholders as dividends. So your baking soap, you know, your cooking utensils, the oven in your house, the fridge in your house, the television in your house. This is just an example of things we can invest in as investors. So when it comes to those of us that want to invest for income, because now you can invest for income or for growth, or you can invest for both at the same time, both income and growth. So for those of us that want to invest for income, I mentioned dividend stock. So if you're ever confused about dividend stocks, because I've said I know that the higher the yield does not always mean that it's a good stock. You can focus by buying something we call dividend aristocrats. They are stocks that have paid dividends consistently for over 25 years, right? And this includes steady dividend growth. So for example, we have ExxonMobil, We have Coca-Cola, we have Realty Income, it's not here. We have Walmart, we have Johnson and Johnson, we have P&G, that's called Procter and Gamble. So all these are examples of dividend aristocrats. So they're going to be paying dividend costs that they never miss dividends. Why? Because of course, but everybody drinks Coke. So something I mentioned earlier, moat. So moat in simple terms for companies, like all the things to look out for when choosing a stock is their competitive advantage, right? So what makes them different? For example, Coca-Cola, there is no drink that tastes like Coke, right? And they're also I think they're those that make Fanta as well. So there's no drink that tastes so, and their recipe, I went to their museum in Atlanta, and you see the vault where they put, I see whether it's one part of their recipe. I don't know where the remaining part is, so that is still there. I don't know. Like nobody knows the recipe. Like even the people working for them, not one person know like all the like one employee does not like they only know bits and bits. So you do this, you finish, move it on to the next person that has the next knowledge that finishes and moves on to the next person. So this kind of company, of course, like it don't like there's no competitor, like forget it. People will always drink Coke. Coke will always be Coke. So these are examples. I know PepsiCo is here as well. I mean, people that like Pepsi. So these are examples of dividend aristocrats. So if you just want to invest for income, you don't know what to buy, you can just search for dividend aristocrats. So websites that can come in handy are websites like NASDAQ, NASDAQ, Yahoo Finance, CNBC, Google Finance, Forest Factory. All those are websites that can help you as you learn about investing on your journey to invest it. So Verizon, right? This is a stock. The current stock price is above 40 now. I think it's almost 50. So now there's a friend of my cousin, I think recently I spoke to her. And so back then, my cousin said, like, didn't know why the girl used to work so hard. Like she worked, she was working a tech job, she was doing and on the side, she was doing cleaning jobs. Like she take any job that she could find. And then one day she quit her tech job because she had saved, I think, about $600,000. She had invested around $600,000 in investments. And so that's kind of portfolio that in a day, you can make 50K if stocks go up in one day. You can make 50K. That kind of portfolio she had. So she quit her job. So you know how stocks are bullish now. In a day, she can make 50 to 100K because she has the capital, right? So I thought, like, when it comes to investing, usually I know the rates might seem small. So the goal is to go for higher rates because we want to grow our money. However, usually the problem is usually not the rates. I like to say that capital because I thought, like, if I tell you to go and sell a house that is worth £1 billion, and I tell you I'll pay you, let's say 5%, you will sell it because 5% of 1 billion is a lot of money. Yeah, so that's what she did. She quit her job, and I think about 200K of that money is in one of these REIT stocks that pays really high dividends, and that's actually what she lives off. That's what she used to pay her rent, do everything, travel the world, and because now she's time free, I know she now does her own job that now literally pays her money. So what I'm saying is this, like, for those that invest for income, simple say, okay, my goal is to have 200K in this dividend paying stock, 200K in another dividend paying stock, and I'll retire, right? Based off the dividend yield. So this is just like an example. Let's say you have 10,000 shares of Verizon and it costs you $402,200. And this dividend yield is 6.61%. Now, again, aside capital gains that you make, your annual dividend will be 26,800, right? So in a month, you're going to be earning $2,233 a month. So imagine if your rent is 1,200, 1,300. I mean, this could be enough to cover your rent and some other basic expenses, or more. So this is just a breakdown of what it feels like to invest for passive income, for those of us investing for income. Now, investment strategies, we have buy and hold, which is long-term investing in strong assets. You just buy, you hold, you're not doing anything. So you could invest a lump sum of money. It could be 5K, it could be 10K in an investment that's going to do well, and you just leave it there. Then we have dollar cost averaging. So this is when you invest regularly to reduce risk. So there are two types of DCA. So there's a DCA where you can say things like, I want to buy one share of this company every month, and you DCA into it. And another DCA where you can say, I want to this a fractional investing where you can say, I want to invest £100 every month, and then you distribute your £100 across all your stocks. So that's dollar cost averaging with fractional investing. On the regular dollar cost average, just investing regularly into the market to reduce your risk. Because again, we cannot time the market. Then dividend investing, like I mentioned earlier, is investing to earn passive income from dividend-paying stocks. Now, again, you're also going to make money through the capital gains. So growth investing is targeting high growth companies. Like I said, growth stocks that can multiply your money real quick. You target high growth companies and invest for capital gains. Then value investing, which is value stocks, is buying undervalued stocks that have the potential. Again, this is where the moat comes in. Because if a stock comes, say, company comes to the, because usually the companies do the same thing, usually on the market. For example, like if the same companies, the same thing on the market, but they usually have something that sets them apart. So if a company comes to say, okay, we are selling bread, you know, I mean, for that company come and say we are selling bread when there are other bread companies, they must be confident in their bread selling abilities, or they must have something different that sets them apart from other bread sellers. So when you look at all these kind of upcoming companies, you want to know, do they have strong fundamentals? What sets them apart? What's the difference? Like when I started investing in BYD, despite the fact that I found that I was not moving as Tesla, that was because I literally read their the CEO's vision and mission from top to bottom. So, and then the name was very appealing to me. BYD simply means build your dreams. And I'm like, okay, you know what? Let me build my dreams. And I invested in the company. And that's a really long-term play for me because I also believe in China ecosystem as well. So these are the kind of things you want to look out for. Like, you know, if you're buying undervalued stocks, you want to know that they have strong fundamentals and they're able to compete. It might not be immediate, but one collaboration or one law can literally change the dynamics of things. Okay, so key takeaways, start with clear goals. Please, if you can do short, medium, long term, by all means, please do so. If you can't, just have a goal, right? The goal is just to make so much money. When you have so much money, all these short, medium, long term goals is not going to be a problem. When you've invested and you've built your wealth, you know that literally, as long as you have goals, it should be smart, you know, measurable, time bound, specific. You can do anything. Then know your risk tolerance as well. For those of us in the UK, we want to use tax efficient accounts, maximize our returns, then diversify to reduce risk and increase stability, and then stay consistent and invest for the long term. Okay, before we get to practical session, please, can you guys ask me your questions? I hope like you guys have learned something from this call, and I did not like bombard you with so much information. Okay, why is everybody quiet?
Yeah, I think there's a lot to take away from here.
Yeah, so as I said, come with your pen and paper. So questions, this is question and answer, and what do you call it? Question and answer time. The first question is, for a medium risk investor, how would a medium risk investor invest £1,000?
Maybe diversify, maybe 500 into ETFs, I would say, and 200 in Nvidia, and maybe 200 somewhere else. I don't know, but I'm just saying.
Okay, growth stocks, high risk. I don't know that high ETFs, medium risk. Okay. Well, that works. That works. I'm not even lying. That works. Okay, the next question is, if your portfolio drops by 20% in a year, what would you do? Number one, sell. Number two, do nothing. Number three, buy more.
I think you should just, like take a thorough look at your portfolio, then rebalance your portfolio. I don't know if that makes sense. But that's what I think I would do. I don't know about selling. So if you maybe you could throw more light, but that's what I think I would do.
Okay, so when it comes to market dipping, so I said guys should ask me a question. Because this question I remembered. When it comes to market dipping, usually when there's a pullback, the market dips by 5%, sometimes 10%. So it's something called pullback after a stock has like done a lot of returns and people are taking profit or things. So something that's what we call pullback. 20% is usually the max for like when they say the market is bearish, say the bears are here. When the market is red, 20%. So very rarely does the stock market drop below 20%. So when it drops below like more than 20%, so I mean above 20%, just above 20%, then there is a serious problem. Example, war, COVID-19, recession. But even this last war, the market still did not drop like by 20, by more than 20% rather. So these are the percentages that the market drops at. You want to look out. So 5% very okay, 10% very okay, 20 even is okay. Again, does not mean that there's anything wrong with the company. It's just a pullback or something we call market correction. So these are things you want to note as well as an investor. So yeah, actually looking at your portfolio and understanding what you should do, that is actually a very good approach. You want to see if you have good stocks that have great potentials that you want to top up. Because like I said, when the market dips, we buy the dip. Look at it this way. You buy a valued company, currently Netflix 1,200, and you put let's say 1,200 in Netflix today. What's going to give you is one share. But if Netflix dips by, let's say, 20% to maybe 1,000, let's say 1,000 to something or 1,100. If you put your 1,200, you're going to get 1 point something stocks. That gives you more value for your money, which is why we say we buy the dip, because what that means is we are buying great companies at a discount. I hope that makes sense.
Yes.
Okay, and that person, how much do you think you need to start investing?
£1.
That's a good answer. Okay, hey. But I like the way you answer that question. So I know that I say you can start with little money and £1, but I find out that when I say that, people literally take my words so literally, right? So
No,
let me not say it again a better way. So I know you can start with £1, but
no, it's not the literal translation of £1, just what you can afford to put in at that moment.
that's why I'm telling that people literally take that, like they will have 5K sitting somewhere. They're not come and buy stock for 50. They're not come and tell me, Jenny, that stock we bought for 50. You did 100%. If I had known, I should have put, and I had 5K somewhere. And I'm thinking them like, you say what? So I like to give this example, right? If I buy a stock for £1,000 and you put £100, if that stock does 500% return, I'm gonna make £5,000. You're gonna make £500. So I'd like to just say that. So everybody should do with that information as they will. Now, again, of course, you can start with whatever amount you feel comfortable with. But I think like the biggest thing is fear. So if I ask everybody now, what's the biggest barrier stopping us all from investing? Sorry guys, I'm trying to log into my app and there's so much authentication process to get me in. Because again, it's an investing app, and I'm on a call, that's why.
I think it is fear. And why I think it's fear is because I had an experience last year. And so that was how I saw your
Please share your
post.
story with us so we can learn. What was your experience? Waiting
That's how I saw your post. I saw your post on Twitter. Then I decided to follow you, and we got talking and all. So last year, out of the blues, I just don't know how I got the idea. I decided to invest in Palantir, and I invested £20, and I forgot about it. A year later, I went back to the stock, and I saw that it's over £100.
Okay.
Like I felt so bad. And the thing is, I could have invested more.
So now you get what I'm trying to explain, what I just explained,
Yes,
right?
and I had the money.
Exactly.
So I had the money. I could have invested more. I could have taken the risk. So what I now did was I now sold the £20, which is over £100. I sold it. Then I now invested £2,000. But though I invested £2,000, but I still felt like, oh, that I could have done this last year. I could have made more money.
So I'm guessing you FOMOed into the market. When you invested £2,000, how much did you what was your entry point? Which I'm gonna show you guys something okay, my account is up. I'm gonna show you something called average. That's one important thing when you're investing. So average just basically shows you like how much you've invested over time.
Poor or limited knowledge.
Well, that's a good one, which is why I said it's intentional. So after this class, what do you think you would do differently to get more knowledge?
Well, just improve on the knowledge I've acquired in the class, because quite frankly, I, so, before now, this whole thing just looked vague. I don't know if I speak for other people when I say, but I speak so for myself. It looked very vague, with the jargons and too many grammar. So the ordinary mind or the ordinary person, like, going into this thing, it looks so big. You can't understand it. So with trying to gain knowledge now, trying to acquire knowledge through these kinds of classes, it just simplifies everything. Now, okay, so this is what these people are talking about. Now you know better. So for me now, though, I think just study more, improve on what I've learned now, and just keep learning and practice actually, and just keep doing, keep learning and keep doing. So that's it for me, though.
Okay, that's great. Okay, so now, okay, so now I mentioned unrealized profit and loss. That's interesting. Why is everything in profit today? Okay, this one's still a loss. Okay, so when I say unrealized loss, now this, can everybody see my screen?
Yes, this is your portfolio, right?
Yes, so this is an unrealized loss, right? So now because I believe in this company, I have great conviction. What am I going to do? I'm going to hold DV like this until it goes back up and put me in profit. It used to be much more than this. This loss, I think it's like about 2000 plus, but as you can see today, it's gone up by 2 point something percent. So that's an unrealized loss. Whilst the green this is profit, quite all right, but it's an unrealized profit as well. So unless I sell, that's when I'm taking profit. I can decide to sell and think, oh, 5K or 10K or blah, but I'm not going to do that, right? Because investing is long term. Now, this one of the stocks I'm going to be buying today, by the way. So I'm trying to look for my average. I just saw it, I saw it somewhere. Now I'm trying to remember. I don't think do I have an average. I don't think I have an average. Okay, I don't have an average for this stock. I'll probably share what other account should I share? Because when I bought this stock so when I bought this stock, I bought it first at $5, right? And then I went up to 9 and I sold and took profit. When I came back in at $10, I bought it at once. That's why I don't have any average. So visually, what your average shows you is your entry points. Let's say, for example, you buy a stock at 10, you buy a stock at $5, you buy a stock at $7, you buy a stock at 20. These are mathematics people should understand what I'm trying to say. People should help me out here. So your average, basically, which is why I said dollar cost averaging is a great way to invest. So over time, it will even out and give you your average, which is like the entry point, the most popular. So nobody knows mathematics here more than me. Nobody understands maths more than me. I'm sure it's only you for the way I understand it. Anyway, by the way, so your average literally reduces over time. You might buy stocks at, let's say multiple prices, and then it reduces. So when it comes checking your average, it helps you know what I think the word I'm looking for is middle value, right? Middle value, you have a group of numbers. So if you spend, let's say, 100 pounds, 200 pounds, 300 pounds on stocks in, let's say, 1 month, if you add them up, you divide by how many times you bought, it gives you the average. So when your average reduces, it's a good thing. I don't know if that makes any sense. So even if you buy a stock at, let's say, 100 today, 200 tomorrow, when your average reduces, it's a good thing. It means that you've gotten so much stock at a very cheaper amount. I hope I actually explained that to the best of my possible knowledge. Oh my goodness, I swear you guys are the most quiet people I've ever thought in my entire life. People are not even giving me ginger. Okay, anyways, I'll continue. So when
Yes, we understand.
I'm understanding you say people are quiet, people are not judging me, please. Okay, now look at my average here. This is what I was looking for. So, but because I've bought and sold before, like I said, my average price is £8. Think. Okay, so when I mentioned market cap earlier, when it comes to things you want to look out for a stock, this is what I meant. So market cap of this stock is 5.91 billion. The volume simply means how many people buy and sell the stock. We have 31.54 million. 52 weeks range basically means the growth of this stock. So a year ago today, this stock was $3.31 per share. Today, the stock is $25.56 per share. So it has made 3 times 10. It has made at least 900% return on investment. So if you had put 10K when it was 3K, even if it's 1K Golden First, you would have seen a great.
We're not seeing your screen. Okay, sure enough.
Can you see my screen now?
Yes.
Yeah, so if you had put, even if it was 1K when it was 3.31, you would have seen a huge and great return on investment. So this is the 52, which is the 1 year price progression. Now, the charts also show the growth, right? So when you see the chart, so you can see how this stock has literally moved. So, and that is, so when it comes to researching stocks, we have fundamental analysis and technical. So everything I mentioned in the class is fundamentals. And to be honest, if you do fundamentals right, you don't even need technical analysis. I always say like technical, you just use it for trading. When I want to invest, I barely use it. Well, unless I want to make quick money, which again, I've been doing this for a long time, so I know how to do it. So, but other than that, you can see how the stock has literally, like if we go to 1 year, let me click 1 year. Let me see if it will change. Change now. Okay, yeah, 1 year. So you can see how slow and steady the growth has progressed over time. So it's not like something we call rug pull, where people just pump a stock to make so much money and then they dump it. No. So another thing you want to know when you're investing in stock, what are the trends? Like what are the things that are going to change the world? Now, AI has come and AI is here. There's gonna be something new tomorrow. Right? There's gonna be something new next tomorrow. Now, so when I say set price alert, these are the kind of things you can do, -10%, 5%, and things like that. So one other thing I mentioned when it comes to researching a stock is analyst ratings. So this stock is a strong buy. So all the analysts, all the investors of this company believe strongly in the stock. So it's rated a strong buy. So what this means is it's still gonna go up. It's really still going to go up. So you can see the news about the company. So this is just a quick, which is why I love this app, a quick fundamental analysis. You see the news about the company, what the company is doing and things like that. Now, earlier I mentioned that investing is a conversation between buyers and sellers. Now, again, you don't have to use charts. I'm just using it to like illustrate something to you. And because I trade, of course, as well. So when it comes to, this is what I mean by buyer. So the red people, this is called candlestick, right? So the red candlestick indicates sellers. The green candlestick indicate buyers, right? This down part where you see the red and the green indicates the volume. So that shows you how much sellers were here on this day. And like I said earlier, when people start selling, they could be selling for various reasons, such as taking profit. And when they take profit, of course, it's going to have an impact on the share price. The share price will drop. Now, when there are lots of buyers, it's also going to have an impact on the share price, and the share price will go up. It will pop, right? It doesn't. So this candle, this stick now is this candlesticks we see. You can see throughout a whole day, this has going to keep coming, buyers, sellers, buyers, sellers. So in a certain hour, there can be a lot of sellers, and then all of a sudden, buyers will just come and take over and push the sellers away. So for example, we can see that here, where these were sellers and then buyers came and took over. So this is just because when I say it's a marketplace and conversation between buyers and sellers, this is what I mean. So every single day you go to the stock market, for every time you want to buy or sell, there's going to be somebody that is there to buy what you're selling and to sell what you're buying. So you can also see the financials of companies here. Yeah, so like I said earlier, market cap, you can see it here. This is how much revenue they've made. EPS means earnings per share, so they don't pay dividend yield, so their earnings per share is in minus. So the way you make money from this stock is capital gains, like you can see. Now in 1 year, the stock has done 163.67% return, even though I say it's 900%, but that's their business chart. Beta this is a much more advanced, so you don't really need this. Average volume just shows how many people buy and sell. Like I said, I showed you the volume of sellers and buyers. That's what it means. You can see the industry. Data Processing Services. It has 205 employees. This is their CEO. Technological Services. Now you can see financial summary. Their revenues increased by 198.92%, which is a good thing, right? Their net assets increased. What I mentioned. Remember, I mentioned net asset value. So net asset value basically means how much assets. So something I was supposed to tell you guys, calculate your net worth. Your net worth is basically your assets minus your liabilities. This gives you like a true financial picture of financial health that literally tells you like whether you're in a good place or a bad place. So assets are things that can make you money, things that are valuable. So think of assets like stocks, crypto, your real estate investments, all those things that asset. Liabilities are anything that takes away money from you, like your debt, your car loans, your mortgages. Those can classify as liabilities. So their net assets increased by 79.15%, which is a good thing. So I mentioned investor relations page as well. You can literally click there to go or go search for it yourself. And this is just like a summary of everything. Then analysis. This is analysis. Sorry, my network is okay, cool. So remember I said like out of 100%, last time I checked, I think this stock had like, was it about 300 and something million investors, if I'm correct. I know PLTR has 780 million investors. So this stock is a buy, 100%. All the analysts have rated this a buy. So it has consistently beat the target. So initially it was supposed to get to $16. It got $16. Then the next amount that was set for it to hit was $21. Now it has currently hit that amount, and now it's going to go up to 30, even though like we presume it's going to get to at least 50 before the end of the year. So when I mention hedge funds, like the institutional investors, this is what I mean. So these are the big guys that manage like top hedge fund companies. So when I mention institutional investors, this is what I mean. They are the ones that have money. Now you can see this particular one is holding $16.83 million worth of share. This has 10.55 million, so has 3 points. So these are people that can move. These are the movers and shakers of the market. These are other hedge fund analysts and all as well. So this is just a simple way to like basically do like your fundamental analysis.
Can I ask?
Yes.
Are there websites which one can subscribe to for news and all that?
I think I mentioned a couple of websites earlier. I said NASDAQ. You can pay for monthly full if you want. Yeah, monthly full, NASDAQ. I don't know, I don't think NASDAQ is paid, is it? You can use Yahoo Finance. That one is free. Google Finance is free. CNBC, I think you also pay for that. Yeah, so these are me personally, not everything I want to do is on NASDAQ. Then for dividend companies, you can use dividend.com if you want to invest for dividend purposes. You can use dividend.com. So I hope that answers your question.
Yes, thank you.
You're welcome.
Please just something on the ETFs, particularly S&P 500. So I was trying to start up and I wanted to like start like doing this monthly stuff, investing in S&P 500. Then I got the investment platform, and when I typed S&P 500, I saw lots of them. I was even confused. I didn't know the particular one. I don't know whether there's a particular one. Like,
so there's just one S&P 500. Every other thing mirrors or tracks it. And the main S&P 500, you can't find it on 3212. It's on eToro, but not on 3212. Every other thing on 3212 is an index fund that tracks the S&P 500.
Okay, thank you.
So what I can say is for trading 212, the one that is better is the VUSA. So ticker symbols differ as well, like across countries. So the fact that it's called S&P 500 in the US don't mean it's going to call the same thing in the UK. Which is why I said that they will have, I mentioned earlier when I was talking about ETFs correlated, I mentioned that they might have different names, but they'll still have like the long underlying ETF that they're tracking there. Sometimes they might have it in full, other times it might be abbreviation, but
Yeah.
you want to be really careful so you don't buy the same thing with different names.
Okay, thank you.
Okay, so we're going to
Still loading.
do,
Okay, you can see it now.
we can do DCA. We're going to DCA into stock, so which is dollar cost averaging, fractional investing. So what that means is, unless like some of you put like a lot of money ahead, then you can maybe buy whole stocks of one. But for those of us that are just, oh sorry, let me minimize this thing. Okay. Okay, it's time to invest, guys.
Sorry, I want to ask a question. I put like 200 there, but what are giving me is 198.49. Today, so
Check
deduct
your
something.
dollar. So they give you more dollar because again, we're
Total
buying US
available
stocks.
cash.
How much do you have in dollar? It should be almost 400, three something. The value
Should I check?
changes to dollar.
How
So
am I going to
bear in
take
mind
that?
that if you deposit pounds, you're getting more dollars. Like your money is not 200, so you don't mistake it as 200 and you not leave money uninvested.
Okay,
So go to your wallet and you'll be able to see your total
okay.
available,
Wallet. Okay, let me check.
yeah, in dollars.
Investment account 198. I can't see any other thing.
Check your dollars, check dollars.
Available USD 266, okay? 0.08. That's what I saw.
Okay, that works. Should there we just do it. Okay. Okay, guys. Okay,
That's
so
it.
you're buying APLD. So please search for this ticker, APLD, or you can type in Applied Digital Corporation.
We start for it. Should we click on trade? Okay, let's go.
Okay, so are we here?
Yes.
Okay. Well, that's not me and you did this class today. So even those on
Yes,
Bumble,
Yes,
yes.
yes. We are here. We are here.
even those on Bumble, please search for APLD as well. I think Bamboo is pretty much easy to just buy. Celestine. Celestine. Am I pronouncing your name? But I don't want to spoil your name.
Celestine, yes.
Wait, are you male? Oh my goodness, that's so fresh.
Yes, I am.
Hi, okay, so APLD, search for APLD on Bumble. We are on APLD on this. So click on trade for those of us on eToro. If you're on Bumble, click on it. Then click on buy on Bumble. Click on buy now. So when you want to buy, so for eToro, right? Now, stop loss and take profit is for those of us that trade usually for us, right? But there are times, let's say you can say you want to buy stocks. So this is also called limit order. So some platforms you can see that stop loss and take profit. Other platforms see that as limit order. So limit order is a way for us, like for mini traders, not like professional traders and all. So what this means is if you buy this stock, let's say for example, I don't put 900, I put like 100, right? And I don't want to buy this stock long term, for example, or you get a signal that says, okay, buy this stock at 21 now, buy $100 worth of shares, and then take profits when it goes to 30. And for most of us now, we are busy, we are working, we don't know how to monitor and time the market. So other than setting price alerts, right? Because again, you might set price alert, and when the alert hits, before you go and do everything you want to do, the price has changed. So what you want to do, you can say take profits when this 1K goes to this 100 goes to 1,000, or I can change it to, let's say, 500. Now, this is if you want to do short-term trading, like buying and taking profit. But because this is not what we are doing, usually, like, we don't use this because you're not a trader, right? So we're not using this at all. We are investing long-term. So put the amount you want to buy. So again, we are going to be buying maybe 2 or 3 stocks. Again, it depends on how much everybody puts, but 2 stocks for the purpose of this video. So 2 stocks that can 3x your money in a couple of months. I mean, by God's grace. So we'll buy this one. So put the amount you want to invest. So you can put half here or half in the last stock. Or again, you can start split your money into 3. So it all depends on you. And then I can add a 3rd stock. But are you guys understanding me, Sha?
Yeah.
Shape was supposed to buy me ice cream to replenish my energy like this. Oh, yeah. So when you put the amount you want to put, for those of us on eToro, just click on buy, nothing else to be done. For those of us using Bamboo, click on buy now, put your amount as well, review order, and send your order. Let me buy.
Click on buy. So
Class
how do
buy.
how do
So
you
I
know
bought
that
mine. Mine
successful?
has, you can see order received.
I've deposited into my account. I can't see the money.
Go to your
I haven't got
wallet.
funds.
Have you gone to your wallet?
Yes, I have. Can't see anything.
Sorry, who is talking?
It's okay.
Tinuke, can you please call me on WhatsApp so you can share your screen? I'm sure the money is there somewhere.
Okay.
But every other person place their order. How am I seeing that?
Janie, on the leverage under that stock,
We're
no
not
stock.
using leverage, no. We're not using that. So I just explained that you can only, we're not using leverage. So leverage is really for when you want to, like I explained for the stop loss, when you want to magnify your profit and your losses, but that's for traders, so don't use that. So if ever you want to use anything, maybe unless you get trading knowledge, but if ever you want to use anything like I mentioned, just use the stop loss. That's for you to set when to take profit and stop your loss. However, like I said, we are literally in the accumulation stage. We're just starting investing. So I always say, like, taking profit is not on our mind. If anything, we should be accumulating, right? Investing more so our money can grow. Because again, if your stock does £100, £100, what's that going to do for you? The goal is to get to a point where you're making 1K, 2K, 10K, 20K. You get my point? So, but in case you want to take profit, yes, that's what it does for you. Like, you can take profit.
Advisable to buy same stock on both eToro and Bamboo if you're doing the two?
No, because why are you buying the same stock? So put that income in one place for faster growth instead of splitting it. You get my point? You don't want to spread yourself
Yeah,
too.
but I was thinking of probably doing Nigeria stocks on Bamboo.
No, you can do Nigerian stocks on Bamboo, definitely. But if you're buying APLD on eToro, don't buy it on Bamboo. Instead, use that money and just like buy it here. Because, okay, for example, you put, let's say, if you're factoring compound interest, you put £100 APLD, eToro, £100 APLD Bamboo, and then it does 50% return. If they're together, factoring compound interest, probably get like 120 or 110, all those small differences. Whilst if you put them separate, you probably get like 50, 50, 100 or something of that nature, and then it makes no sense. You just put them to consolidate as much as possible. But for Nigerian stocks on Bamboo, you can do it, even though, like I said earlier, I always recommend boycotting third parties and investing directly. You get my point? So I'm not saying Bamboo is bad. It is good. However, it's a third-party platform. They are not an authorized brokerage. So if you invest with them, they have their own brokerage as well that they give the money to, and you get charged fees. So remember I said your fees can eat into your return on investment. So you're better off just boycotting them and investing in that brokerage that they are using. Okay, so our next stock is going to be even though I wanted us to buy Meta, should we do Meta instead? Well, let's do SoFi. So remember when we did the analysis for APLD, it's still the same thing. Analyst forecast says buy and hold. The price targets for the stock, the all-time high price target was $20.22, and you can see it has exceeded that because current price is $27, so it has made so much profit. 1 year range, the stock was $7 this time last year. For the 2 weeks range, 7.60 to 30.94. So it's gone from 7.60 to 30.94. So when I say things like there's going to be a pullback or a -5 or 10% return, so there's been a pullback from that 30 to 27, which again could be because people are taking profits, which is not really a bad pullback, even though for someone like me, I'll be saying it's not enough, but I've learned how to buy, take what I can get really, because again, it's not my father that owns the stock market. So yeah, you can see the CEO, it has 5,000 employees. It was founded in 2011. It's headquartered in California, USA. What is one stock I wanted to buy, but I can't recommend this, but I really want to buy this stock. Oh my goodness. Okay. Was in my watch list. Okay, so we're gonna do the same thing. Click on trade. Put the amount. And then click on buy. Okay, so as simple as that. So does any other person have any money left so we can buy something else?
Yeah, Jenny, we can do one more stock now.
Okay, one more stock coming. Okay, so usually in times like this, I'm usually torn between stocks to buy. So I'm gonna give you guys the stock list as well that you can buy later. So I said we can do income and growth. So EPR Properties is one of my favorite REIT stock. They pay dividends every month, right? I'm gonna add it to the list. I'm gonna say income stocks now. So we can either do IIPR. Should we do IIPR? Why can't I see I just saw it now. Okay, this one. IIPR. So this is a REIT stock. Oh my goodness, it's going up. This is a REIT stock. And if you go to the financials, you know how I said REITs are real estate investment trust mandated by law to pay out 90% of their profit as dividend to shareholders. So if you go here, you can see that this stock, the dividend yield is 13.96. That is very high, right? So, and this aside the capital gains that you would have made on the stock. So talking about capital gain, if you see the 52-week range, it's gone from 45 to 137. Now it's currently at 54, and this is because, of course, they pay out high dividend yield, but stock still has potential to grow, and also it is real estate. It pays high dividends. So this one, another of my favorites is EPR. EPR, I think EPR is 7%. So EPR Properties is an entertainment property company. So think of the casinos, your cinemas, your Disneyland-ish thingy. They either lease or manage these assets. So if you come here as well, you can see that their yield is 6.07. 52-week range is 42 to 61. So in 1 year, they've done at least 10, 20, I think 20-something% return on investment. That's from capital gains. That's aside this dividend yield you're going to make as well. Okay, so these are going to be our third stock. So which one do you guys want? The IIPR that pays 13% or this one that pays 6%? I did both of them on purpose so you guys can choose based off of what we
IIPR.
discussed in the class. Anyway. All right, we can do that. IIPR it is. IIPR. I know someone in the UK, well, not directly, through one mentor of mine that has, is it 500 or something K in this stock? That's just balling, basically. They're just balling. Okay, so the same thing, click on trade. Put the amounts you want to put, 200, and then click on buy. And guys, that's it. Congratulations. See how easy it is to invest. Now, all you need to do is to decide you want to get knowledge. Because again, with knowledge, it gives you conviction on things to buy. For example, because I had started researching APL derived from when it was $5, that's how I was able to dump 30K into it. And now fast forward to today, it has more than doubled my money. That's giving me about almost £40,000 return on investment. So with research comes conviction. Like I said, the simple fundamental analysis can literally give you everything you're looking for.
Monday is not true.
The market, trust me, I thought like the stock market is something you want to learn. It is a skill that nobody can take away from you. Because if you think about it, when we talk about the richest men in the world, they are rich because of the value of the company on the stock market. Jeff Bezos, Mark Zuckerberg, Warren Buffett, it is all tied to the stocks, which is why I said the money you can make from stocks is limitless. Like I'm not joking, like it is limitless. Like there was someone in my group, literally, I was just showing them. She invested $330, £330 in a stock called Gryphon Mining. Very crazy play that we just dropped on the group. And that stock made her 3,000 something percent return. So her £330 grew to 7,000 something pounds in less than 1 year. I don't think it was even up to 9 months, Seth. Right. So these are the kind of things that can happen for you as long as you're invested, as long as you want to get knowledge. People like, see me, I'm in the UK, I thought I don't have a 9 to 5. For me to decide I don't have a 9 to 5 and I have bills monthly, I've been traveling since August, literally. I don't think I've been in the UK since August. And I still pay my bills because I'm making money from the stock market. It's like something as simple as even buying this IIPR tomorrow morning when it drops maybe to, because every day the stock prices move, they move and they drop. Something as simple as waiting for it to drop to 50 and buying, and then waiting for it to go back to 54 during the day and selling. If I put like 5K in that kind of play, that can make me, let's say, between 70 to 100 pounds in 1 day, every day. Now imagine rinsing and repeat for stock. So of course you want to get the knowledge first, but these are things that you can literally do to make money. Like I said, the market is very liquid. That is how the rich people get richer. You can do it too. It is not rocket science. There are so many ways, from buying and holding, stocks trading, with something we call dividend capture strategy. That's you guys' assignment. Go and research something called dividend capture strategy, to dividend investing, to value stock or penny stock investing or trading. There are so many ways you can make money from the market. The group is going to be there for a while. And yeah, I'm also going to drop a list of stocks that you guys can buy. Okay, guys, so we've come to the end of our class. And it was nice talking to everybody. And consistency, that is the goal. Remember the illustration I gave. If you have £100 in a stock that does 500%, you're going to make £500. If you have £1,000 in a stock that does 500%, you're going to make £5,000. So the goal is consistency. At least build your stocks to, I always say build your stocks to 1K each before adding extra, because if you build to 1K and the 1K grows through compound interest, you can now start building upon that 1K and the interest and things like that. You don't spread yourself too thin, diversify. So we've bought the stocks we bought. I bought a fintech stock, we've bought a data and tech stock. So those are 2 industries. So now for those of us that bought IIPR, that's a real estate investment trust. So that is proper diversification. Yeah, so with that, we've come to the end of the class, and congratulations, everybody.
Thank you.
All right, good night.
Lastly, Jenny, what about days that things are not going right in the stock? So how do you cope about it? How do you cope, and
When
what
the
do we need
market
to
is
do in such?
bearish?
Yes. As
So
newbies, definitely we're going to panic and stuff like that. So
definitely,
what do we
yeah.
do
Which
at
is
that
why
time?
I said mindsets, which I think one of the mindsets is emotional intelligence. So usually when the market is great, and again, having a community helps. Because me, I have like an investment group. So usually I just tell them like, close your eyes, don't open your app unless you're opening to top up, like to buy, right? So for me, over time, I think I have a thick skin. I'm used to it, right? The only thing I tend to say is the market is funny, right? So which is why I always say, like, for me, how everybody gives advice of buying ETFs. I don't do that because I want to grow my money. So before, like for example, now I see this stock now, this AP, I'm going to take profits before the market drops. That one I'm sure. So what I've learned is, for me, what I'll say is I tell people like reward yourself and take profit. I mean, not for us that just started today now, we're just starting. Talking about those that their profit are in thousands. For example, like I have people that make like 5K, 10K just from one stock, right? I always like reward yourself, even if it are 2K, take it out and do something. So, but usually, which is why I say have conviction. You're buying solid companies, right? SoFi currently is like the most popular finance platform in the US because it has the most highest interest rates for a bank for high yield savings account. And that's one of the reasons why they've grown so much. There's nobody I know in America that does not use SoFi. So these are good companies. APLD is data center. So AI is booming now. So every AI company will need data centers. That's why they are growing. So think of NVIDIA and all. They have partnerships, collaborations with NVIDIA. So these are solid companies, right? So that alone is conviction. Because I always say, like, if you're scared about a stock or you're panicking, it's because you do not have the knowledge. You do not do your research. You get my point? So because if you have conviction, you've done your research, you have the knowledge and all, you will not really panic. So usually when it's during the dip, just ignore, just see it as it happens all the time. The bearish market comes, bullish market comes and goes. Like for example, September used to be one of the worst bearish markets of like in the year, ending of August, September to October. However, for some reason, since Trump became president, things have not been the same. But for some reason, September has been bullish instead of bearish, right? I think the next time is between April or July. So we already know this pattern, right? So we just keep money to like buy the dip and all. So it's economics. It is simple macro and microeconomics. The same way that government increases interest rate today, they reduce it tomorrow, all them fiscal policies. That's how the market is. It's just that law that say whatever that goes up will come down. The thing is, as long as you have solid companies, in fact, most of the markets really will run once the bull run comes. As long as they have solid companies, it will go back up. I remember I said that when they go back up, they usually exceed the previous high. So if you had a company that's 1K that went to 1K, now dropped to 500 or 600, 700, when it goes back up, it's going to go back to like above 1K. It happened with Netflix, it happened with CrowdStrike, it happened with Meta. It's happened with most of these stocks. So don't panic, like literally don't panic. Which again is a long-term thing. You're building long-term wealth. Have a long-term mindset. Have an investment mindset. Like I said, read the news, I mean, you'll be fine. Initially, you feel those jitters and all, but one thing I always say is buy the dip. As long as it's a great stock, you're not buying to take quick profit. When it dips, instead of panicking, look for money to buy the dip. When it goes back up, usually you regret not doing it as an investor. Okay, so what you want to do is get knowledge. And like I said, once you get knowledge, all your fears are there, especially because, like I said earlier, it's an unrealized loss. It's when you sell, it becomes a final loss. So you don't lose anything. Just close your app and go and sleep, or you buy more.
Sorry, just a quick one. What if in a situation we know that definitely there's going to be a dip, like you said, probably in September, there's always a dip then. What if I take out the money and when it goes down, I buy it again? So instead of keeping the money down, watching my money going down.
So you said, how I mentioned average. It's so when I said, I remember even in the beginning, like I cannot time the market. I told you how like there are stocks where like they are high. I always think they are high and I'll set alerts and they never come down. Okay, so I mentioned support. And can you guys still see my screen? I mentioned support and resistance. Not for here. I have to share my screen, share the screen. These are good companies. I have issues. They usually, so government intervenes, right? So there's usually a merger and acquisition, or government appoints a company to take over. So case example was the Silicon Valley. Silicon Valley, by the way, one of the biggest companies, banks, and it's like, so think of all your tech, most of the tech startups we have in the world, they funded them. But which is why I say when it comes to things we cannot control, which is a systemic risk like government policies, all it took was one government policy to run them out of business. And because they were so valuable, the government appointed like a couple of banks to merge with them and buy them out. So I don't think I've known any company that got liquidated, to be honest. I don't think I've really heard. anything serious. Last time I read about it was a long time ago, but I can't really remember. But what I do know is it happens everywhere, even in Nigeria. When wasn't this hotel? Hi, is it Nikon Nuga? Or I think it's Nikon Nuga. When they had issues as well, right? The government, AMCON, so Nigeria, what in our Nigeria, the name of the government agency that bails businesses out is called AMCON, right? I know that one for certain. America, I'm trying to remember their name. So government will always intervene as long as the company that's valuable to the country and to the economy. So for example, I thought when I remember I mentioned Tesla early, why Elon Musk does certain things I get away with is because he's a creator of employment and infrastructure. So he built, I remember he had the law case in Atlanta. Was it Atlanta or Texas? I can't remember, but one of these states where he was building huge charging plants and factories, and the government of that state literally just turned a blind eye. I'll go and research it. Like, so I remember like when I was in my master's, I read that like I was prepared when it was happening, So if a company like Tesla tomorrow has issues and wants to go bankrupt, you think the government will allow it to go bankrupt? How now? So that's why I said you want to invest in companies that have great fundamentals. So that's what will give you that security. So when I talk about resistance, and support, so now there are certain stocks that will not drop. So if you know how you said dip now, you don't know if you bought a stock at 100 and it goes up to 200, the dip is coming, right? And then you sell. What is the guarantee that that stock is going to dip back to 100? Because again, it has to dip for you. It has to go back to 100 for you to have said you have made a profit for you to re-enter, right? Or it has to go less than 100. Oftentimes, like I said, the dip is usually a pullback. It could be 5%, 10%, 20%, 40% is usually in extreme cases of things like war, COVID-19, global, and that's usually the one that happens worldwide, that everybody in the world feels it, right? But usually pullbacks are between 1%, 2% to 20%, right? Now, I mentioned earlier about support and now this, for example, now this area, I'm trying to let me do this. Okay, so if you see here, for example, right, this used to be support for a while, right? And here, this used to be resistance. This is for Tesla now, right? So whenever like it wanted to like break over here, I'm trying to move this back, right? Okay, so support, resistance. Whenever it came here, it will always come down. Whenever it tried to go up, that price always come back. Because this was where its price was, like the price was being resistant. This was the support. So it's either come back down here or it's come back to the middle, but it never went above this one. Now, the day it finally broke above that resistance, you see it has gone up. It is not coming back to this level. Neither will it ever come back to this level. Now, this is now the new support. I don't know if you understand what I'm trying to say. Do you guys understand?
I'm trying to understand.
So because I trade, so I feel like you're taking me to the advanced part. This is usually for us that trade, right? So support and resistance is one of the key indicators for us that trade. So something called market structure. So Tesla has not had the best market structure. So what stock has a good market structure? So what that means is just being everywhere. It's up, down. So there are three ways a stock can move. It can either go up, come down. So green means it's going up. Red means it's coming down. Then sideways, like here means sideways. It's consolidating. It's neither going up nor coming down in this particular area. So it's moving sideways. It's consolidated from here up until here. So these are the three ways a stock can move. Now, this has been the support for Tesla for a long, which means this is support 437. It doesn't go below 437, right? While this has been resistant, so it's not gone above 439 for a while, right? So imagine that you bought at 437 and then you wanted to have sold at 439 when it went up, said, okay, that when it drops again, you now buy at 437. And that's the like now breaks resistance. So as it broke this 439, you see that it has always gone up. It has not come back to this level because it has broken resistance. Now, the only thing that can make Tesla come back to this level is if maybe there is a bearish market, like a very, very, does more than like 20% dip or 40% up to 40% dip. So one of the key, let me use on that app and that stock. Let me try Meta, for example.
Sorry, Jenny. Please, are you trading on the 1 minute?
Yeah, I trade on the 1 minute a lot.
Damn.
So it's either 1 minute or I swing trade.
Okay. Options, yeah.
Yeah, options. It looks like
Okay.
like, okay, this is what I mean when I say stock is consolidating. This is so for us those that trade, this is like a bullish. Well, let me not confuse people. Sure, I'm trying to look for a good stock that I'll use and drive home my point. Okay, let me use APLD. Let me search for APLD. I think that would work better. Okay, so now APLD, this has literally been support resistance for a while. And even though the market structure is weird, let me do 1 hour. Let's see if that will work better. Okay, I think this works better. So when I say market structure, this is what I mean. So if you look at this stock, it's been doing higher highs and higher lows. So that's what we call market structure. You want to look at the movement of your candles, right? Which basically indicates your buyers and your sellers. So by looking at the charts, you can tell how a stock is going to be. So if you want to, for example, which is why I say so many ways you can make money from the stock market. So for example, I have this stock, I'm holding it long term for wealth. But at the same time, I also trade it for quick gains, right? I'm able to understand kind of the market structure. So it has done a steady growth. So you can see it's broken support resistance. So it goes up. It's not going to come back here anytime soon. This has been support for like a while. Then it's been doing higher highs and higher lows and higher highs and higher lows and higher highs and higher lows. So even when it came down a bit, it still did not come down to this previous low. It created a new low and then it's going back up. So what I'm trying to say is that most stocks will not come back to the price you got it. Like if you miss that train, you've missed that train. The only thing I'll say, however, is taking profit is good because if you rebuy, let's say when it dips again, if you have huge capital, and then that stock goes on to make another 100 or 50 or 200% return, then you still made profit. But you've already deleted or eroded that compound interest from like the beginning that your wealth can grow on, that'll give you more return and reduce your average. Should be equal understanding. You know what? Our brain is tough. We'll continue tomorrow. Okay, everybody. Good night.
I was just